Yes, friends, now let us discuss about the circulars, certain clarifications in various chapters, starting with your circular in your levy of GST. So, this circular basically talks about taxability of ESOP options, employee stock options, ESPP or RSU, when it is given by a company to its employees, but company is not directly giving to its employees through its overseas holding company. It is discussed in circular 213 in total and 7 circular of 2024. See, technically, when you talk about your employee stock purchase plan or employee stock option plan, the difference between employee stock purchase plan, employee stock option plan, and when you talk about restricted stock units is typically ESPP and ESOP are the options given to the employees, whereas restricted stock units are a case where only if at all you achieve a particular thing, achieve a particular target or performance, it is nothing but an award given which is contingent depending on employee meeting a particular performance standards. Technically, see, whether it is ESPP or ESOP, employee stock purchase plan or option plans, these are the options given to employees. They can exercise it on satisfaction of basic conditions. Restricted stock units are again the same type. The only difference is RSUs. It is not open for everyone. It is dependent on your performance. If at all you meet a particular performance which is set in the contract, then that will be given to you. It is not open for all the employees. Now, what is happening in this entire scenario? If it is directly given by a company to its employees which is within the employment contract, then it is not at all subject to tax, because it is services by employee to employer in course or in relation to employment. So that is out of it. But what has happened in this particular case? So there is a foreign holding company and there is an Indian subsidiary company, and there are employees of this Indian subsidiary company. Now, employees are of Indian subsidiaries companies. Now, there is an employment contract between the Indian subsidiary company and the employees of Indian subsidiary company, through which they will be getting shares of foreign holding company as a part of ESOP or ESSPP or RSUs. Now, these shares will be given by the foreign holding company directly to employees of the Indian subsidiary company. And for this particular shares given by the foreign holding company to Indian subsidiary company will be giving the reimbursement. So shares will be transferred directly by the foreign holding company to the employees of Indian subsidiary company, between whom there is no contract. An Indian subsidiary company will make the payment in terms of reimbursement. It is in terms of reimbursement. Now, the circular is very categorically said that both are non-taxable. The first contract between the Indian subsidiary company and the employees of Indian subsidiary company is nothing but a contract which is covered by para 1 of your schedule 3, which talks about services by an employee to employer in course or in relation to employment. So even if the shares are given as a part of employee stock option plan or employee stock purchase plan or restricted stock units plan, even if it is not belonging to the Indian company shares, it is belonging to foreign holding company shares, it is not taxable. Therefore, this part, the first contract is not taxable. Now the question comes, what about the shares actually transferred by foreign holding company to the employees of Indian subsidiary company. Between them, there's no contract. The contract is for this entire thing. The contract is between foreign holding company and Indian subsidiary company. So Indian subsidiary company tells that foreign holding company, you please transfer the shares to my employees. I'll give you the reimbursement. This is nothing but transfer of shares. Transfer of shares, which is neither goods nor services in terms of section 2 clause 52 and section 2 clause 102. Therefore, this also is not taxable. The only thing that can be taxable here in this entire transaction, if at all, along with the reimbursement, there is some service charges, extra amount, additional charges. Only and only this amount. This reimbursement is pakka non-taxable, but the service charges, if at all it is taken, if the foreign company tells that for transferring my shares to the employees of yours, I'll be taking the reimbursement, which is nothing but the listed price of my shares plus some extra charges. Only this extra additional charges which is collected by the foreign holding company from the Indian subsidiary company, if at all, the main shares value will not be taxable. Only the additional service charges portion will be taxable, and if at all it is taxable, it would be taxable under RCM. The Indian subsidiary company will make the payment. So that is the discussion of this entire lengthy circular. So this entire thing is given in this entire lengthy circular. Right, don't see the length of the circulars. Never ever see the length of the circular. The essence of the circular will be very, very simple. Now next, there's another circular in the same chapter, levy of GST, where the discussion is all about salvage of the wreck value in the claim. If at all there is a damage of motor vehicle, the insured person will go to the insurance company, and there will be obviously a salvage of the wreck value of that particular damaged motor vehicle, which would be sold later on. What will happen with that? So this is discussed in circular 215, and the number is 215 means in entirety is 215, and 215 circular in entirety, and 9 circular of 2024. Now, what generally happens for insurance companies? The insurance companies who are taking the insurance of the motor cars, if at all there's some damage in the motor vehicles, they will pay for the cost of repairs of the damages to the policy holder. It could be categorized into two categories. The total loss would be paid back, or the partial loss situation. Now, what would be the treatment? Now, let us understand what would be the possible treatment. There would be two possible scenarios. Basically, let us understand both the possible scenarios. If at all, the insurance company tells that we will make the final payment to you after deducting the values which are pre-decided. We will not make payments for something, so for few items which are mutually agreed upon, right? And in such case, what will happen? The insurance company's liabilities will be limited to the insured declared value less the salvage or the wreck value of the motor vehicle. If at all there is a total loss of the vehicle, there is nothing which is left out. It's only scrap. So the insurance company will tell that I will give you my declared value, whatever you have agreed. I will be giving you a particular declared value. My risk is limited to this, less the salvage value in case of total loss. Now please understand that in such a case, the agreement is entered into such a way that why it is not paying for the salvage of the wreck value is because the property, the ownership of the motor vehicle remains with the insured person and not of the insurance company. Whatever is the salvage of wreck, it is not becoming the property of the insurance company. It is the property of the insured. Therefore, please do understand this particular breakage. Insurance company may come out and help that I will be helping you in selling this salvage value or the wreck value. I may help you, but understand that insurance company will just act as a facilitator by giving some competitive quotes for the salvage or the best value, and the insured person is always having an option to sell it in open market. The ownership of that salvage of wreck is remaining with insured company. Insurance company is not going to pay. There is no liability for the insurance company to pay on the salvage value, not at all. It cannot, the deduction of the salvage value cannot be treated as any consideration. Right, so that is the first situation. Second is a situation where the insurance company will make the full settlement of insured declared value, whatever is the as per the agreement, insured declared value, without deducting the salvage of the wreck value. Again, that is very clearly in the contract. In such a case, the property of the salvage becomes a property of the insurance company, and when the insurance company is selling that salvage of wreck, it has to pay output tax. So this is very, very categorically said, and the concept is pretty simple. Insurance company is an insured person in case of motor vehicle. We are talking about, say, motor vehicle. So if at all there is a full loss, insurance company, there are two ways where we are talking about what? It is a case where you are talking full loss. There is a full loss. Only in case of full loss, there will be salvage or wreck. Right? Otherwise, the property still remains with the insured company. So we are talking about full loss where the motor vehicle is gone. There are two possible options. One, insurance company pays insured declared value less the value of the salvage or wreck. Second, the insurance company pays the full insured declared value without deducting it. Please do understand, in such a case, the salvage or the wreck is the property of the insured. Therefore, and insurance company may help the insured person to get a reasonable quotes for the salvage of wreck, where the insured is having an option to sell through those competitive offers that he is getting, or he might sell it in open market. So in such a case, on the sale value of salvage or wreck, insurance company will not pay any GST. It might be the sale of insured, but insurance company will not pay any GST. So you might ask whether insured person, if at all he is registered, he has to pay GST, but insurance company will not pay GST. In case where insurance company makes a full payment of insured declared value, the property in salvage of wreck, it becomes a property of the insurance company. So in such a case, on the sale value of the salvage of wreck, insurance company has to pay output GST. It's very simple. You have to just understand what is happening. As per the contract, if insurance company is selling that, see, I'll pay you the insured declared value, but not, I'll deduct the salvage or the wreck value because it is your property, you can sell it. And if you're selling it, you might have GST liability. It's not my property. I'm not going to pay GST. I might help you in getting competitive offers. The second case, insurance company pays full insured declared value. The property of wreck or salvage becomes a property of the insurance company, and when it is further selling that salvage of the wreck, it is going to pay GST on the same. So that is in this particular circular. Simple circles. Don't see the length of the circulars. Never ever see the length of the circulars. Concept would be pretty simple. Now we are moving on to the circulars which are dealing with your valuation chapter. Now there's one circular which is circular number 228 in totality, 22nd circular of 2024, which talks about GST on incentive which is paid by Ministry of Electronics and Information Technology, otherwise called as METI, to the acquiring bank. There's already a circular which tells that any payment which Ministry of Electronics and Information Technology which is paying to the acquiring banks for what transactions? For transaction in BHIM UPI transaction or RuPay debit card transactions, not all the transactions, RuPay debit card transactions and BHIM UPI transactions where the value of the transaction is up to 2000. For small value transactions using RuPay debit cards and BHIM UPI transactions. So METI is going to pay an incentive to the acquiring bank An acquiring bank further shares this incentive with the issuer bank, and issuer bank further shares this incentive with the payer payment service provider. So there's something called as payer payment service provider and UPI apps. So it is sharing of incentive. This entire sharing of incentive, this entire sharing of incentive, I'm going to write it as this is sharing of incentive which is paid by Ministry of Information and Ministry of Electronics and Information Technology, which is nothing but central government. You can tell this as subsidy given by central government, which is not part of valuation. Therefore, it will not attract any GST. Right? It is sharing. Ministry of Electronics and Information Technology will only give it to acquiring banks, and they will further share it to issuer bank, and issuer bank will further share it to payer payment service providers and UPI apps. So this is entirely happening through national payment. This is all in terms of National Payments Corporation of India. This is in a manner decided by National Payment Corporation of India along with decision taking by Ministry of Electronics and Information Technology. So this is entirely by way of National Payment Corporation of India. So this entire thing, all these incentives, be it incentive paid by METI to acquiring banks, which is further shared. So this further sharing will also be treated by a subsidy given by the same METI to issuer bank, which is further shared between payer, payment service providers and UPI apps, which will also be treated like sharing of subsidy. This is nothing but subsidy given by the central government, which is not part of valuation, therefore no GST. But just to differentiate it, this payer payment service providers may pay to third party apps. This may pay to third party apps. Now understand that when it is paying this, sharing this incentive with third party apps, this is not in a manner which is decided by National Payment Corporation of India. Therefore, please do understand, this particular payment by payer payment service provider India to third party apps will not be treated as subsidy by central government. So this won't be treated as, this is not in agreement with the METI and National Payment Corporation of India. It will not be treated like subsidy given by central government. Therefore, it is included in valuation. Therefore, on this particular sharing of subsidy, which is actually who's the service provider? Service provider is the third party apps, and who's the service recipient? Service recipient is the payer payment service providers. So this particular sharing of incentive, which is not in agreement with METI and National Payment Corporation of India, this could not be called as subsidy given by central government. When this cannot be called as subsidy given by central government, it is included in valuation. GST is payable, for which service provider is a third party apps and the service recipient is payer payment service provider. So this is the net crux of this entire circular. So what they are trying to tell, if central government is paying the subsidy in form of incentive, though it may not pay directly, it may pay indirectly. MET is not paying directly to the issuer bank or directly paying to payer PSPs or UPI apps. It is paying indirectly. It is subsidy by government, not part of valuation. But if the same subsidy or incentive is further shared by payer payment service providers to third party apps for the service provided by them, then this is not treated as subsidy by central government. This would be part of valuation. GST would be payable. So this is this particular circular. Now, the next circular, which is of not much use in the long run, because the circular will not be of no use when your invoice management service will come into picture. So that is not as of now, but it will come into picture. Then this would not be helpful. Now, this circular, which is circular number 212 in totality and 6th circular of 2024, it talks about what are the conditions. I mean, what is the evidence for the conditions given in section 15.3, which is all talking about post supply discount. So even if it is post supply discount, you can give a credit note as per section 34, and even that is excluded from the value. But there is a condition that you can reverse your output tax, but with the condition that your customer should reverse proportionate ITC. So as a supplier, if I am giving a discount to my customer, can I reduce that from value and reverse output GST? Yes, supplier can reverse output GST, but recipient has to reverse proportionate ITC. But as of now, supplier has got no system functionality facility to check whether the recipient has reversed the proportionate ITC. So what is the way out? The way out is that in this particular scenario, they have to get a declaration. They have to get a declaration. If the amount of tax is not exceeding 5 lakhs, they have to get a declaration. Normally, they have to get a CA-CMA certificate if the amount of tax is more than 5 lakhs. If the amount of tax involved is less than 5 lakhs, they have to get a undertaking or a declaration from the recipient telling that I have reversed the proportionate ITC. But if the amount of tax is more than 5 lakhs, then they have to get that particular declaration or certificate from the chartered accountant or cost accountant of the recipient telling that this recipient has reversed the proportionate ITC. Now, what would be the content of that declaration, whether self-certified by the recipient or through a CA-CMA? It will contain the details of credit notes. It would contain relevant invoice numbers and what is the ITC reversal that is done, whether that ITC reversal is done through a voluntary payment channel DRC03 or in a return, on which return, etc. The main invoices and the corresponding credit notes and when it is being reversed. Whether in return, if return, which return, or whether through voluntary payment DRC03 channel, that particular details has to be given. So this would be helpful for the supplier if at all any notice comes to the supplier telling that yes, you have reversed the output tax. So what happens in case of post supply discount? So post supply discount, which is reduced from value by the supplier can reverse output tax, but with the condition that recipient has to reverse ITC. But the problem with this entire scenario is, what is the proof that recipient has reversed ITC? The evidence that recipient has to give to the supplier that it has reversed ITC is either a self-certificate or a CA-CMA certificate. If the amount involved of tax is less than or equal to 5 lakhs, it is self-certificate. If the amount involved is more than 5 lakh, it is CA-CWA certificate. What would be the content of that certificate? That the recipient, for the invoices on which credit was availed and the credit note on which credit is to be reversed, the recipient has reversed the ITC through these returns or by these voluntary challans. So that would be the content of this certificate. Why this would be required for the supplier? Supplier may require these certificates from the recipient, either self-certified or CA-CMA certified, depending on the value of tax, not the entire value, depending on this particular amount. 5 lakhs is the amount, total amount of tax, CGST, SGST, IGST and compensation cess. Right. If at all any notice comes to supplier in future telling that, see, you have reversed your output tax for post-supply discount, what is the proof that the recipient has reversed ITC? Give these certificates. So that would be helpful. But as discussed, this is relevant only till the introduction of invoice management system, because that would be automatically taken care of when IMS is introduced. Yes, friends. Now let us see certain more circulars on your valuation chapter, but all these circulars, they are related to your rule 28. That is, you're talking about valuation in case where the transaction is between related person or distinct person, and focus is only on valuation if the transaction is between related person. Now, the first circular, which is circular number 21004 2024, 210 overall circular, and fourth circular of the year 2024, where you're talking about related person. Now, let me summarize this circular in a very simple manner, that if at all you're talking about transaction between related person, normal case rule 28(1), and related person special case rule 28(2). This talks about all goods and services, and the second one talks about your corporate guarantee services. Corporate guarantee services. Please do understand that whether it is a normal case or the special case, again here, whether it is domestic transaction, which means related person 1 is in India, 2 related person 2 who's also in India. Secondly, it is a case where you're talking about international transaction. Related person 1 is outside India, and related person 2, recipient, is in India. So supplier, recipient. Third scenario, related person 1 in India and related person 2 is outside India. The same three scenarios can happen with your corporate guarantee services. Related person 1 in India, recipient related person 2 is also in India, or related person 1 is outside India and related person 2 is in India, or related person 1 is in India and related person 2 is outside India. Again, supplier on the left hand side, recipient on the right hand side. Now, please do understand certain points. Now, firstly, please understand the second and the third case. Second is importation of service. This is domestic service. This is importation of service. This is export of service. It is not only domestic service or domestic goods. Domestic service or domestic goods, because it can have both goods and services. Here it is only domestic services, corporate guarantee services, importation of corporate guarantee services, and exportation of corporate guarantee services. Now, whatever is the case, if at all the related person is eligible to take the credit, if the recipient is eligible to take full ITC, in that scenario, any value, including no value, 0, any value for that matter, any value, including 0, not putting any value also is deemed open market value. If the recipient is eligible to take full input tax credit, the recipient is eligible to take full input tax credit, whatever value you'll put, even if you don't put invoice, not a problem. Any value, including 0, is deemed open market value. Rather, this circular is only trying to tell one thing, that if at all you're talking about Rule 28, and if the related person is outside India, and the recipient related person is in India, it is importation of service. And by the way, if at all it is importation of services, it is RCM. Importation of services is RCM. Importation of goods is customs duty. Again, it is RCM only, but technically not RCM, customs duty. Importation of services means it is always under RCM. So this clarifies that even for them, any value, if you don't put any value, if you put any value on invoice, that is deemed open market value. Even if you don't put invoice, that's fine. That's completely fine. Actually, the circular only touches this. But what I have done, I have not only taken that particular part of circular 210/4/2024, but I wanted also to touch 224/18/2028, where it is talking about corporate guarantee services between related persons, where this is given, there you're talking about a scenario, if at all corporate guarantee services is between domestic parties, related person 1 in India, then it is FCM, forward charge mechanism. If at all it is between person who's outside India, supplier outside India, and recipient is in India, then it is RCM. That recipient related person will pay. But also I wanted to cover one more point, that this particular Rule 28(2) will not cover export of services. If at all, it is ulta, corporate guarantee services. Specifically, you are talking about corporate guarantee services. If at all, supplier is in India and recipient is outside India, recipient is located outside India, your Rule 28(2) shall not apply, and the case will go up back to Rule 28(1). The case will go back to your Rule 28(1). So why I have not touched this area is, in a scenario where corporate guarantee services, related person is in India, but the recipient related person is outside India, that is export of services, your Rule 28(2) will not be applicable. The case will go to your Rule 28(1). However, the fact that if the recipient is eligible, here recipient will not be eligible for full ITC and all. The reason is, when you talk about export of services, technically recipient is outside India, so taking credit is of no use. And secondly, exports are zero rated. So recipient is eligible for full ITC is only relevant as far as both the related persons are in India, or it is import of services. That is, supplier related person is outside India and recipient related person is in India, import of services. In that case, recipient will pay under RCM, pay in one hand and take the credit in other hand. So any value will be taken as deemed open market value. It is a case under RCM. The recipient, the supplier of this particular transaction is outside India, recipient is in India. It is importation of services which is covered by RCM. He has to pay, he has to raise invoice, no worries. Can he ignore raising invoice? Yes. If at all is eligible for full ITC, he need not even raise invoice, because any value including 0 is deemed open market value. And in this, what I have done is, I have taken this understanding even to a Rule 28(2), which talks about only corporate guarantee services. What are the difference in Rule 28(1) and Rule 28(2)? Rule 28(1) talks about transaction between related person, any good services. Rule 28(2) talks about transaction between related person, only corporate guarantee services. Only corporate guarantee services. So this is the entire understanding. Here. Now, moving on to the next circular, where you're talking about importation of services. Again, it is basically importation of services. So it is a continuation of that it is importation of services. But the supplier who's a related person outside India, overseas affiliate related person, is giving loan to its Indian related person, what will happen? So when a supplier outside India is giving a loan to recipient in India, what will happen? It is explained in circular 218 bar 12 bar 2024. That is 218th overall circular and 12th circular of the year 2024. Again, this is again dealing with the importation of services only, rule 28.1 only, and is not dealing with corporate guarantee services. So we are not moving to rule 28.2. Now what is happening here? Now it is trying to tell that supplier is a foreign company and recipient is an Indian company, and both of them are related persons. Both of them are a related person. Supplier foreign company is giving loans to the recipient company. Now department was trying to tell that when loan is given by this supplier outside India to recipient outside India, whenever loan is given, there's always processing fees or documentation charges, etc. Loan processing fees. Please understand that when you talk about loan is mere transaction money, no GST. Interest on loan which will be paid back by the recipient to the supplier is exempted. So this interest which will be paid back is exempt. GST is not paid. Loan, no GST. Why loan, no GST? It is mere transaction in money. Why on interest on loan, no GST? Because it is exempt. That is a supply, but it is exempt. So the reason is different. Loan giving and roll repaying is mere transaction money, no GST. Interest on loan, no GST. There is no processing fees. Generally, there is no processing fees. But department is trying to tell that as a transaction is between a related person, any transaction between related person, even if it is without consideration, it will be covered by deemed supply. So deemed supply, para 2, schedule 1. So actually, loan is given and paid, interest is paid, but processing fees is 0. But even if processing fees is 0, department is trying to tell that it is deemed supply. Any transaction between related person, even without consideration, supply without consideration, schedule 1. Para 2, transaction between related person or distinct person, it is deemed supply. Now, even though it is deemed supply, for deemed supply you will go for rule 28 valuation. Rule 28 valuation. Now, in rule 28 valuation, basically the focus first is on open market value. So this circular explains what will be the open market value. Now please understand, generally if a loan is from third party, why does anyone charges? Assume that loan is given by unrelated person to unrelated person. Why will anyone charge? Why will anyone charge processing fees or documentation charges? There are a lot of factors which goes into that, because they will see the credibility of the receiver. They will see what is the repayment mode, what is the source of repayment for them, what is the collateral that is given, whether there is any guarantee which is given. They will see the financial records, income tax statements, they will see P&L balance sheet to see their working capital, etc., etc. So when any loan is taken by us from an unrelated person, they do a lot of things. They see our basic health check. They will see the financial stability of the recipient by seeing the credibility, source of repayment, taking collateral, guarantee, taking the income statement, taking the financial statements, taking the projections, seeing the financial stability of the recipient. And for this, processing fees is generally charged for all these works. But when a loan is given by one related to another related person, when a loan is, this is between unrelated person to unrelated person. So there will be some processing fees. There will be surely a number. There will be some processing fees for sure. But when a loan is given by one related person to another related person, processing fees will be 0, because that related person knows very well about that another related person. Supposing, related person outside India is giving loan to related person in India, he knows everything. He knows the credibility of the related person, the source of repayment, collateral is not required, guarantee is not required, income statement, he automatically has it, financial statement, he can easily access to it. So open market value in such cases will be 0. Open market value in such cases will be 0. Right. So this is a very clear understanding that yes, when you talk about one related person giving loan to another related person, loan clearly is not subject to GST, mere transaction money. Interest on loan not subject to GST, exempt. Whether giving the loan always has got something called as processing fees. Whether department can tell that there is deemed supply para 2 schedule 1 between related person, and though technically they are charging processing fees nothing, but you have to take open market value. Yes, you can go with open market value, plus understand that here open market value, when any loan is given from one related person to another related person, open market value will be 0, because whenever loan is given to any other related person, they don't charge anything. They don't charge anything. Though the circular tells otherwise. If you see the end of the circular, you'll find an author's note. Circular tells a very different story which I don't buy, but end answer is the same. Circular tells that there is no supply at least. There is no supply. Treating it as supply itself is not required. Therefore, no question of open market value. So circular actually tells that there is no supply at all, but in fact there is a supply, because loan is given by one related person to another related person. There is a supply. 100% there is a supply. You can always tell that that supply, there is a supply, even though there is no consideration, it is between related person. So it will be covered by para 2 schedule 1 or even para 4 schedule 1. So that is the supply. What I have given in the author's notice, although the circular tells that open market value cannot be taken because there is no supply, the better way to understand is there is supply, deemed supply para 2 schedule 1, but the open market value of the processing charges for the loan between related person will always be 0. So you can understand in that particular manner. So that is this understanding of the circular. Now moving to the last circular between your related person, but this time the initial circulars are all about rule 28 sub rule 1. Now it is all rule 28 sub rule 2, where you're talking about transaction between related persons, and this transaction is of corporate guarantee services. Services by way of providing corporate guarantee. What will happen in that particular case? Please understand that whenever a loan is taken by a person, bank will expect some collateral guarantee. A related person can give guarantee to the banks or financial institutions, telling that if this loan recipient is not paying the amount, I'll take care of it. Supposing there's a holding company, there's a subsidiary company, this taking for example related person 1 and related person 2. There's a bank or financial institution. Bank or financial institution is giving loan to the subsidiary company, but the bank guarantee, but the corporate guarantee for this loan is given by a related person, holding company. When the corporate guarantee is given by the holding company, who's the supplier? Supplier for this corporate guarantee services is the holding company. Recipient for this corporate guarantee services is the subsidiary company, on whose behalf guarantee is given, and this particular service is called as services by way of providing corporate guarantee. And valuation for this particular thing, if the transaction is between a related person, it is valued under rule 28 sub rule 2, and rule 28 sub rule 2 tells that the value would be taken as 1% per annum of corporate guarantee value, or actual consideration what is taken for giving this corporate guarantee. The holding company may take actual consideration, whichever is higher. 1% per annum of this corporate guarantee value, of the guarantee value, or actual consideration, whichever is higher. So who's the supplier? The related person who's giving the corporate guarantee to bank or financial institution. Who is the recipient? On whose behalf this corporate guarantee is given? That is the recipient. What is the service? Services by way of providing corporate guarantee, and if at all it is between related person, Rule 28 sub Rule 2 will be applicable. Assuming it is a domestic corporate guarantee or importation of services, which means either both the parties are in India or supplier is outside India, recipient should be in India. If supplier is in India, recipient is outside India, as discussed, it will be export of services. Rule 28.2 will not cover it. It will go back to Rule 28.1. What is the value here? 1% per annum of corporate guarantee value or actual consideration. This is the background. Now there are certain doubts, few doubts, conceptual doubts, and few are conceptual queries, few are number based queries. Now the first conceptual query, whether this 1% per annum is on what? 1% per annum is on guarantee amount or the loan given. Supposing the holding company is giving the guarantee that you can take a loan of up to 10 crores, giving the guarantee on 10 crores, and loan given by the bank to the subsidiary company as of now is 2 crores. 1% will be calculated on what? 1% is calculated on the guarantee given, not on the loan sanctioned or the loan given. It is not on the loan sanctioned or the loan given. Because holding company is ready to give guarantee up to 10 crores. Whether the loan sanctioned is 2 crores and loan given is 2 crores or 1 crore, that is not a lot. That is the first point. Second, if at all that is transfer of loan. So this is the first question. Second question is basically taking over of existing loan by one bank to another bank. If at all the loan is taken over, bank once loan is taken over by bank 2, right? So we are talking about takeover of loan. Taking over of loan. The loans are taken over and already GST is paid on 1% per annum on the guarantee amount or actual consideration, which is higher. Taking over of loan, initially first guarantee was given to whom? Initially corporate guarantee was given to bank 1. Automatically when loan is taken over, the same corporate guarantee will be taken over to bank 2. Just taking over the loan automatically will be accompanied by guarantee also will go to it. Please understand, now just because bank 2 is coming into picture, there is no additional GST liability. Taking over of loan will be followed by guarantee being transferred to the new bank, no GST liability. But yes, they have again clarified, if at all there is any fresh guarantee, if at all there is any new or fresh corporate guarantee, then surely GST will be applicable. Again, 1% per annum of the guarantee amount or actual consideration, whichever is higher. Please understand, when loan is taken over by one bank or financial institution from another bank or financial institution, guarantee also will follow. That will not create new GST. Already there was a GST liability which was paid. Here already GST liability was paid. Taking over of loan along with the corporate guarantee will not create any GST liability. But if any new or fresh corporate guarantee is given to the new bank, that will attract GST liability. Third and fourth one we have already discussed. That your Rule 28.2 will not be applicable for your export of corporate guarantee services. It will be there for import of corporate guarantee services. It will also be there for domestic corporate guarantee services. If the recipient himself is outside India, for this you have to go with Rule 28, Sub-Rule 1. And taking over it, when you talk about domestic corporate guarantee services, where supplier related person is in India, recipient related person is in India, it is a case that of FCM. And when you talk about importation of corporate guarantee services, where here both supplier in India plus recipient in India. Here supplier is outside India plus recipient in India, then it is covered by RCM. These are all conceptual queries addressed by this particular circular. These 2, 3 and 4th point we have already discussed when we have seen the first circular. Now, few number based queries. Which are raised in the circular and answered it. What will happen if there is co-guarantors? Guarantors are multiple guarantors. What will happen in case of multiple guarantors, co-guarantors? Co-guarantors, ideally it will split 0.5 percentage and 0.5 percentage. If there are two co-guarantors, if there are guarantees given by related person A and it is also given by related person B, that 1% will be split. You will not treat it as 1% per annum at all. You will treat it as 0.5% per annum of guarantee amount or actual consideration, whichever is higher. But if co-guarantors, this is in a general scenario. This will happen in a general scenario. But if the co-guarantors specifically tell that related person A will give guarantee for 60%, so 0.6% per annum, and related person B will give guarantee for 40%, which means total percentage is 1% per annum of guarantee amount or actual consideration, which was higher. So this is all guarantee amount. And all these figures, please understand, this is only one part of the answer. All these figures will be compared with actual consideration and you will take whichever is higher. So this is only one part of the answer, 0.5% of guarantee amount per annum if it is general scenario, 0.5%. If specifically related person A tells that no, I will give guarantee for 60% of the loan. Say loan is 1 crore, I will give guarantee for 60% of the loan. So 0.6% of 1 crore. And the balance person will give guarantee for 40% of the loan. But you take the entire value of loan, 1 crore multiplied by 0.4% of guarantee amount. Right? You can read this otherwise also. Right? So this could have been understood in a different manner. Supposing guarantee amount is total loan is total guarantee is 1 crore. Either you read it as 0.6% of 1 crore, 0.4% of 1 crore, or you read it as 1%. What he is taking giving guarantee 1 crore multiplied by he is taking guarantee only for 60%, or 1% of total loan is 1 crore, he is taking guarantee for 40%. Both of them will give the same answer. This is one part of the answer compared with the actual consideration. Right, so this is one thing, guarantee is given, co-guarantee is given. Number based query, there's one more number based query about per annum. Per annum. Suppose guarantee is given for only 6 months, or guarantee is given for 5 years, and the guarantee is given for loan of 5 crore. Guarantee is given for a loan of, guarantee is given for 5 crores loan. Now, in this case, how you will calculate the value? In this case, the value would be calculated as total is 5 crores multiplied by 1% is per annum, so 6 divided by 12, or actual consideration, whichever is higher. If it is given for 5 years, one shot it is given as 5 years. So 5 crores multiplied by 1%, this is per annum, so 5 years. This will be one shot, or actual consideration, whichever is higher, one shot. In the year of giving guarantee itself, we have to give. But normally this 5 years will not happen like this. This 5 years will happen like renewal. First year, second year, third year, fourth year, fifth year. If that is a scenario, then you will not pay together. If guarantee is given together for 5 years, then this would be the answer. If guarantee is given every year, renewal is there. This is called as renewal. This is called as renewal. Then in that case, it will be 5 crores multiplied by 1% for first year, or actual consideration, whichever is higher. The same way it will be repeated next year separately. I am not going to pay it together now itself. I'll pay next time when I'm giving renewal separately. Third year again I'll pay it separately. Fourth year again I'll pay it separately. Fifth year totally again I'll pay it again separately. So this is the significance of per annum. If the guarantee is given only for the 6 months of the year, then the guarantee amount is 5 crores multiplied by 1%, 6 by 12, or actual consideration. If it is given for 5 years at one shot, no renewal, 5 crores multiplied 1% multiplied by 5. So here there is no renewal concept. But normally it won't happen like that. Every year renewal will be there. So first year 5 crores multiplied by 1%, or actual consideration, which is higher. Second year again 5 crores multiplied by another 1% per annum. So this would go on. So this is the understanding of this lengthy circular. There are totally 6 issues, 4 conceptual based questions, nothing to do with much number, and rather 2 number based questions. So all these 6 issues we have discussed. So that is all about your circulars with respect to valuation chapter. Split into 2. First, general circulars for valuation chapter. Next part, the circulars, 3 circulars which are dealing only and only with your rule 28. Out of that, 2 circulars are dealing with rule 28.1, and 1 circular was dealing with rule 28.2. But that 1 circular which was dealing with rule 22 is a lengthy circular. It talks about 6 issues. Yes, friends, now let us see certain circulars with respect to your exemption chapter, basically dealing with 12 bar 2017 CT rate and 9 bar 2017 IT rate, exemptions for services. And the first circular is quite pretty simple circular, which is circular number 228/22 2024, that is 22nd circular in 2024, and overall 228 circular, GST on insurance services. Basically, in insurance terminology, there's a term called as retrocession, which technically means reinsurance, whereby part of the assumed reinsured risk will be given to another insurer or cross-border reinsurer, so sharing the risk. So it is nothing but reinsurance. And when you see exemption notification, there is an when the main insurance is exempted, reinsurance is also exempted. So it is hereby clarified that when reinsurance is exempted, whether it is called as reinsurance or whether it is called as retrocession, which is nothing but reinsurance, both are exempted. A very simple clarification, which means whether it is reinsurance includes retrocession. Now the next circular basically deals with government services. The question asked in the circular number 228/22 2024 was on GST payment on statutory collections made by RERA. So when you talk about real estate regulatory authority, which is called as RERA, Real Estate Regulatory Authority, it is whether it is a governmental authority, and if at all it is a governmental authority, whether any statutory collections collected by RERA will be subject to GST. Now, you need to have a context when you're going to say this particular point, because when you talk about RERA, what is the function performed by RERA? RERA is an institution or a body which is constituted under Real Estate Regulation and Development Act 2016. It is performing the function of regulating the real estate development and construction, which in turn is falling within the entry number 1 and entry number 2 of 12th schedule. Now please remember this 12th schedule of Constitution, because this will have a connection. So it is a regulatory authority which is constituted under an act, and it is performing the function of real estate development and construction regulation, which is in fact covered in your 12th schedule. Now, in the exemption notification 12/2017 CT rate and 9/2017 IT rate, exemption is given to services given by governmental authority if at all any function is performed by them, which is a municipality function by them. If government is performing municipality function or your panchayat function, it is not at all supplied. But now governmental authorities performing any municipality function which is as per your Article 243W. And when you have to see Article 243W, it has to be read along with your 12th schedule. First of all, interconnect both. Is RERA a governmental authority? Yes, RERA happens to be a governmental authority. So first condition is satisfied. It is service given by a governmental authority. Second, with where 90% control is by government. Second, whether it is performing a municipality functions as per Article 243W of your Constitution. Yes, Article 243W of a Constitution has to be read along with 12th schedule, and 12th schedule entry number 1 and 2 talks about regulation of your real estate development and construction. So it is very much covered within this. Therefore, any statutory collection collected by RERA is exempt. By which entry? Given services given by regulatory authority, RERA is a regulatory authority, and municipality related functions under Article 243W. Yes, the function which is performed by it is a municipality function, because when you see Article 243W, go to 12th schedule. In 12th schedule, you will find these activities. Right. Now, the next two circulars are all about your educational institution. So these entries are there in educational services. We are discussing circular number 234 in totality on 28th circular of 2024. Now, both the circulars are related to affiliation services. Please understand that when you're talking about affiliation services, the first circular talks about affiliation services given by universities to colleges. Second part of the circular talks about affiliation services given by central and state educational boards to schools. So first is university to college, and second is your central and state educational board or councils to schools. Please understand that when you talk about your affiliation services, when it is given by university to colleges, so first is all about colleges. Second, when it is given by central or state educational boards or council to schools. So the first part of affiliation services, that so and so college is affiliated to so and so universities, and so school is certified by CBSE or state board and all. Affiliation services. So affiliation services by university to college, you will not find in any exemption. It cannot be said to be it is related to admission of a student in any colleges. It is taxable. Rather, both are taxable. There's no exemption. The only exemption which is given is for schools when it is given by affiliation is given by central or state educational boards or councils to government controlled schools. To government controlled schools. So only this area is exempt. So affiliation services given by university to colleges is taxable. Educational boards to schools is taxable. But if at all it is given by central and state educational boards or councils to government run schools, it is exempt. When I tell government run schools, they have defined, I mean, this is a new entry which is there in your exemption. So this is related to your amendment. So when I tell government run schools, this is because of the new entry which is added. It is schools which are established or owned or controlled by central government, state government, union territory or local authority, or governmental authority or governmental entity. So this is a new entry which has been added. That is about affiliation services. Another clarification in the same circular with respect to services given by Director General of Civil Aviation, DGCA, when you're talking about airlines, and their approved flying training courses which are conducted by FTOs, flying training organizations. The courses are also approved by DGCA, and the organizations, flying training organizations, are also approved by DGCA. Now, is it exempted? The answer is very simple. Yes, it is exempted. And the reasoning is simple. The reason is, when you see your educational entry, you would find that education as a part of curriculum for obtaining a qualification recognized by law is exempted. Education categories are three: preschool education, education as a part of curriculum for obtaining qualification by law, and skill development courses. So here, education as a part of curriculum for obtaining a qualification which is recognized by law is exempt. And please understand that when you talk about your flying training courses, they're all approved courses by Director General of Civil Aviation, and the flying training courses are conducted by flying training organization which are also approved by Director General Civil Aviation. And without this, you cannot get licenses, whether private pilot license or commercial pilot license. Any person who want to get a license for flying the airlines, he will not get a license. Therefore, it is very clear that these approved flying training courses, which are approved by DGCA, by approved flying training organization, where it is mandatory for any person to get a license, whether private license, private pilot license or commercial pilot license. It is mandated by DGCA to complete that particular certificate. Only then you will get a license. Therefore, it is nothing but, it is covered by this entry: education as a part of curriculum for obtaining a qualification which is recognized by law. Yes, it is recognized by law, because even when the courses which are run by DGCA are all under law, it is all through what? Section 5 of Aircraft Act, read along with Aircraft Rules 1937. This is all covered by this exemption. Now, moving forward, the last two circulars are dealing with your composite supply. So both the circulars are dealing with your composite supply. Circular numbers 234, 28 circular of 2024. One talks about GTA services, one talks about construction services. In GTA services, they have said that services of transportation along with ancillary services like your loading, unloading, packing, unpacking is nothing but incidental or ancillary. So it is part of composite supply. Whatever treatment is there for your transportation charges, the same treatment will be there for your loading, unloading, packing, unloading charges, whether it is FCM or RCM or tax rate, everything would be the same. How GTA's invoicing will not at all affect it. But however, it gives an exception telling that if at all these services are given in isolation, they are not given for transportation of goods. Supposing I am a person to whom services is given by a GTA, but it has got nothing to do with transportation of goods. They are giving me these services not along with transportation of goods, but in isolation, then it will not be composite supply. So first they clarify that these are all incidental services. Loading, unloading, packing, unpacking and all, these are all incidental services. they will be part of component supply where the principal supply is transportation charges. But however, if these are provided in isolation, the contracts are itself separate, then it might not be part of composite supply. The same way they have clarified for construction services that when you talk about construction, at times supposing there's a building which is being constructed and I tell that I want the top floor of that building. So the builder will tell that normally square feet charges is so and so, but if you want the top floor, along with per square feet charges, you have to pay me extra charges, which is nothing but preferential location charges. Along with the basic amount for the residential or commercial properties, I'll pay an extra amount, premium amount. That premium amount is nothing but preferential location charges. Supposing I want my house or my office at the top floor of that particular building, I have to pay preferential location charges. Now, it has been clarified that preferential location charges is integral part of construction services. Therefore, it is nothing but principal services, construction service. It is part of composite supply where principal services, construction service and preferential location charges is incidental. So whatever is the tax treatment for the principal service, construction service, will be the same amount for preferential location charges. If the construction amount charges say 2 crores and preferential location charges is say 50 lakhs for the entire 2.5 crores. Whatever is the rate, if it is 5% for entire 2.5 crores, 5%. If it is 12%, 12%. If it is exempted, it is exempted. So it is a part of composite supply. So that is clarified for both. So last two part of the circulars, rather if you see this entire clarification and exemption chapter, last two are dealing with composite supply, and before that 3 circulars were dealing with your educational services, and before that you had certain clarification, insurance services and your government services. Right, these are all the circulars which you have in your exemption chapter. Now, talking about circulars in time of supply, there are 2 circulars, and both the circulars, there's a common point that they focus on continuous supply of services. The logic of both the circulars is continuous supply of services. Now, the first circular, it is talking about what circular number? 221 in entirety, 15th circular in 2024. It talks about supply of construction of road along with maintenance when the National Highway projects of National Highway Authority of India is given to a party, which is technically called as concessionaire under hybrid annuity model, HAM model. It is called as hybrid annuity model. Now, please understand what is a contract of. Contract is not only of construction but also of maintenance of roads. Given by whom? Given by National Highway Authority of India under hybrid annuity model, where construction payment will be given now, initial payment, and remaining payment will be given over years because maintenance is also required. So this would be operating as build, operate, design, build and operate and transfer model. So you will be getting an initial big lump sum amount for construction of roads. Thereafter you will be getting a payment. Supposing the contract is for say 100 crores. So initially you might get say 30 crores or 40 crores, and thereafter the payment will be for over next 15 or 16 years for operation and maintenance. So you'll be getting a lump sum amount for construction initially, and thereafter balance payment. So out of 100 crores, 40 crores you will be getting now, 60 crores you will be getting over a period of 15 to 17 years. The question is, what would be the time of supply in such a case? Now please understand that the essence of the entire hybrid annuity model. So this hybrid annuity mode, please understand this entire hybrid annuity mode is nothing but a single contract, which is not only for construction of road but also for maintenance and operation of that highways. So it cannot be segregated. You cannot segregate that contract. And when you understand it, please understand that this entire thing, construction of roads and operation and maintenance of roads, is falling under the definition of continuous supply of services, where the payment will be made in installments. So it falls within the definition of continuous supply of services. When anything is falling within continuous supply of services, please understand two things will come into picture. First, you have to see what is the due date of invoice. Then in terms of section 13, you have to see what is the time of supply. And this entire discussion we are doing for your continuous supply of services. The due date of invoice normally in case of continuous supply of services is due date of payment as per contract or completion of event as per your contract. The contract is clearly talking about the due date of payment, that is the last date for invoice. If it is not talking about payment, it is about event. If you're completing this event, you will be getting the payment as per contract. Rare cases where there's no due date of payment in the contract or no payment is not based on completion of event, then it will be actual date of payment. Right. So it is depending on the contract whether payment will be paid on time basis or completion of event basis. I'm not talking the last part where nothing is there in the contract, then it is actual date of payment. And time of supply. Time of supply. If invoice is given in time, invoice is not given in time. If invoice is given in time for a service, it is actual date of invoice or date of receipt of payment, whichever is earlier. If invoice is not given in time, it is not due date of invoice, it is date of provision of service or date of completion of service or date of receipt of payment, whichever is earlier. So first of all, you have to understand that in this hybrid annuity model where you will be getting lump sum payment for construction of roads, highways now, and thereafter it will be annuity every year basis you will be getting for maintenance part. Please understand this entire contract for construction of road, highways and operation and maintenance of highways is under hybrid annuity model, which is a single contract. So you cannot bifurcate the contract, therefore it is continuous supply of services. Now please understand these due date of payments will be as per contract. So finally the time of supply will be given in a very simple way for all these national highway projects. First you find out due date of invoice for every payment, for every installment. You do it for every event. You will not do it in entirety. You will divide this continuous supply of services into many events, and you will do it for each event. So you will do it multiple times. Please understand, whenever there is continuous supply of services, you will break that continuous supply of services into multiple events. In this case, first event is construction of road, then every year maintenance charges. So there will be about 15-16 events. First is construction of road, then every year maintenance. So you will break this into multiple events, and for each of the event, for every such event, first step is finding out due date of invoice. See the contract would be very clear. If due date of payment is given, you have to raise the invoice before the due date, or if due date of payment is not given, it is completion of payment is based on completion of event, you raise the invoice before completion of event, which is there in the contract. And post that, time of supply for each of the event again. If invoice is given in time, you have to raise the invoice before the time given in contract, the last date of payment in the contract, or if that is not given, based on completion of event. When you complete this, you can raise the invoice. If at all you raise the invoice in time, the actual date of invoice, or when you get the payment, which was earlier. Again, please understand that this will be done every time. It is not a single answer for this continuous supply of services. You will split that into multiple events. And if invoice is not given in time for each of those events, then it is date of completion of service or date of receipt of payment, whichever is earlier. So that is explained in this entire lengthy circular. Also, it is clarified in addition is, if at all any installment is paid late by National Highway Authority of India to the concessionaire or to the contractor, it will pay with some interest, and interest on delayed payment of consideration is also part of the value. So that is already part of valuation chapter. That is very clear from valuation itself. Right. There is another circular which is dealing with time of supply, and this circular also talks about continuous supply of services. The difference is this would be under your reverse charge mechanism. So when you talk about circular 222 16 2024, 16 circular of 2024, it talks about time of supply in case of services of spectrum usage and other services given by your Department of Telecommunication. Right. Now the question is, when you talk about spectrum is allocated to say Jio or Airtel and all, the successful bidder, which is the telecom operator, Jio company or Airtel, will make the payment in installments under a special option called as deferred payment option, which will be given as per frequency assignment letter. This payment will be given in, they will give two options, either you pay totally or you will pay on deferred basis under as per frequency assignment letter, which is given by Department of Telecommunication, Government of India. Now these telecommunication operators have two options, either making the payment in installments, which is mentioned in the notice inviting application and the frequency assignment letter, and in such a case what would be the time of supply. They have an option. See, they can make lump sum payment, but they have an option. The successful bidder has an option to make the payment in installment, which is mentioned in notice inviting application. It would be said that you can make the payment in such and such installment, and the frequency assignment letter, which is given by your Department of Telecommunication, Government of India. What would be the time of supply? Please understand that spectrum allocation services is one particular service. Now that it will be assigned over a period of time, so this also is covered by your continuous supply of services. Why? Because the telecom operator will be getting services over a period of time, and he is opting to go and make the payment in installment over the contract period in installment. So this would be continuous supply of services, because it is going to be exceeding, the payment is going to be in installment and the supply is going to be for more than 3 months. So it is again satisfying the definition of continuous supply of services. The only change here is, in the previous case, the supplier was the contractor or the concessionaire and the recipient was government, NHAI, forward charge mechanism. But in this case, the supplier is Government of India, Department of Telecommunication, Government of India, and the recipient is telecom operator. Right. So this particular service is covered by RCM. Supplier is government and recipient is telecom operator. In the previous case, the supplier was the concessionaire or the contractor, and the recipient was National Highway Authority of India. So previous case, it was FCM. Supplier was third person and the recipient was government. In this case, supplier is government and the recipient is telecom operator. Therefore, it is covered by RCM. Spectrum services given by Government of India to telecommunication operators is covered by RCM. So this is a case, classic case, which is covered by RCM. Now please understand, nothing changes. What happens in case of continuous supply of services, even when you talk about your reverse charge mechanism? The first thing you have to find that what is the due date of invoice, which is the same that we have already discussed. Second step is you're going to talk about time of supply for RCM cases, not for FCM cases, for your RCM cases. Again, as discussed, continuous supply of services will be split into multiple events because the payment will be there in installment. What is the due date of invoice? The due date of invoice would be the due date of payment as per the contract. In this case, the due date of payments will be clearly given in the frequency assignment letter. Right? It will be due date of payment. I'm not going to discuss about date of completion of event or actual date of payment. It will be clearly given in the contract. Due date of payment is clearly given in the contract. How you can find due date of payment? If you see frequency assignment letter, that will clearly talk about the due date of payment. along with the notice inviting application. So clearly you can find out what is the last date for your payments. And what is the time of supply? Time of supply in reverse charge mechanism is the date of payment in your books or date of payment as per your bank, or 60 days from the date of any invoice or document issued by the supplier. Rather, to be very specific, 61st day, though it is date after 60, a day after 60 days, you can write it as 61st day. If you see the legal language, it is a day after 60 days. So you can write it as 61st day of invoice given by the invoice or any document given by the supplier, whichever is earlier. So the difference here is, in this case, the notice inviting application and frequency assignment letter will clearly give you the due date of payment. So first you find out the due date of invoice, which will be the due days of payment as per the frequency assignment letter and notice inviting application. Later on, you see what is the actual date of payment in your books and bank and 61st day of invoice or supplier. But what is surprising in this circular is what answer they have given us: actual date of payment, which is the first part, or due date of payment. Surprisingly, they don't talk about 61st day from the due date of 61st day from the invoice of the supplier. So they don't talk about it. If you see the last part of the circular, actually the answer should have been actual date of payment or 61st day when the invoice should have been, invoice or document is given by the supplier. Actually not even the due date. So here, first of all, due date was not at all required. Directly you could have find out time of supply because it is actual date, 61st day from the actual date or document of invoice. Here one doubt came out whether this frequency assignment letter can be treated as your invoice, which is not. It cannot be treated as your invoice. Now understand why they talk about actual date of payment or due date of payment, because invoice would have been given long back. So the moment they have given the entire invoice, you are getting the facility of payment in installment. That is the reason, if you see the last part of the circular, they tell that for the full upfront payment, time of supply is when the payment is made or when it is due, whichever is earlier. And if it is a deferred payment, time of supply would be when the payments are due as per the frequency assignment letter and notice inviting application, or when it is due, which is earlier. The reason for this is invoice would have been given long back, and that is the reason they don't discuss about 61 days. And finally, the circular has clarified that this you don't apply it only for this particular case. In any case where you're talking about any natural resources or anything is given by government to a successful bidder, and where it is continuous supply of services, and where they have option to make the payment either upfront or in installment, you apply the same circular. So in the end part of the circular, you might be confused. You would rather tell that why this due date of invoice is required, because time of supply in case of RCM is actual date of payment as per books or bank, which was earlier, on 61st day from the date of invoice of the supplier or any document given by the supplier. Now, why they don't focus on 61st date from any document given by the supplier? Because it would have been given, invoice would have been given long back. Invoice would have been given long back. When invoice is given long back, 61 days would have been over long back. So they tell that it is actual date of payment or the due date of payment, because invoice is given long back. So it is rather a benefit or a concession, which I feel. But strictly speaking, this circular is not in line with the BAR Act or legal language. So they rather give a relaxation, that telling that okay, you don't go with invoice. Government might not have given us invoice. Government is telling that this is notice inviting application and frequency assignment letter, where we have clearly said that you have to make the payments, which means you treat it as any document. You have to make the payments because the language uses 61st day of invoice or document given by the supplier. So this would have been, the time of supply would have been long back. But the circular gives a relaxation telling that you don't focus on the 61 days at all. So circular ignores the language BAR Act and it tells that it is actual date of payment or the due date of payment, whichever is earlier, which is beneficial for the assessor. So that is about this particular circular. Yes, friends, now let us discuss the circulars with respect to your input tax credit. There are a lot of circulars when you talk about ITC, but all are simple basic circulars. Now, the first circular talks about what is the time limit in terms of your section 16 subsection 4 for claiming ITC on RCM supplies if at all they are received from unregistered person. So this is clarified by circular number 211 and /05, that is 5th circular of 2024. Overall 211 circulars, but 5th circular of 2024. Now please understand the question. It is talking about a scenario where it is an RCM supply and the supply is received from an unregistered person. In such a scenario, if supplier is unregistered person and recipient has to pay under RCM, he has to be registered person in terms of your section 24, that is compulsory or mandatory registration. Please understand the fact that it is outward supply for supplier and inward supply for the recipient. RCM, in such a case, the document for RCM would be your self invoice. It would be your self invoice. So this document in this case would be, why I am calling it as self invoice, because normally invoices of the supplier, but here self invoice will be raised by the recipient himself, and this particular recipient first will pay RCM by cash ledger and then it will get the credit in credit ledger. First there will be payment, then there will be claim of ITC. The question is, first point that you need to understand is, if at all there is a supply which is made by a supplier who is unregistered and it is liable for RCM, therefore recipient is a registered person, compulsory registration. The document which is required in such a cases will be self invoice which is raised by the recipient. And in such a case where normally recipient, what they'll do, they'll pay the RCM on your inward supply by cash ledger and then claim the credit because it is an inward supply. Now what is the time limit here? Please understand, the time limit here depends on what time limit, basically depends on the date when invoice or the debit note is raised. So when the invoice or the debit note is raised, in this case self invoice, then the time limit starts. The time limit is 30th of November of next financial year after the year in which invoice or debit note was raised, or actual date of annual return of that financial year, whichever is earlier. Now please understand, the time limit for taking the credit depends on the self invoice. If the RCM was that of financial year 23-24, the self invoice should have been raised in financial year 23-24 and the time limit would be 30th November 2024 or actual date of annual return of financial year 23-24, whichever is earlier. But it might happen that you raise the self invoice rate. If at all you are raising the self invoice rate, let us not go with this particular year concept, let us go with month concept. Supposing this RCM was of say February 2024, invoice should have been raised in February 2024 and therefore 30th November of next financial year will be 30th November 2024, right? Because next financial year is 24-25. But if at all you are doing this late and you are doing this in say May 2024, first of all, for raising the invoice late, you will end up paying RCM with interest. For late raising of invoice, you will end up paying RCM with interest. So payment will be of RCM plus interest in terms of your cash ledger. and then you will claim the credit in your credit ledger. Interest will be a cost. Interest will be a cost. So first you will pay RCM with interest, then you will claim ITC, but not interest portion. Interest will be a cost. So if you are raising your invoice late, interest would be a cost. Self-invoice rate. In case where the supply is say of the month of Feb, but you are not raising the invoice in Feb, you are raising it late, you have to pay RCM and take credit. Pay by cash and take in credit. But in such a situation where you are paid late, interest would be a cost. And also secondly, self-invoice is now raised in financial year 24-25. If you are raising it in financial year 23-24, next financial year is 24-25. But if the self-invoice itself is raised in financial year 24-25, 30th number of next financial year will be 2025. So please understand, time limit will also extend. First thing, two important things. That if you are raising your invoice, RCM, self-invoice late, you have to pay RCM with interest and claim the only tax portion, credit portion in credit ledger. Pay the tax with interest by cash ledger, but get only the tax amount in your credit ledger. Secondly, time limit might change because time limit is based on the date when you have raised the invoice. So if you have raised the invoice in financial year 23-24, 30th number 2024. But if you have raised the invoice, self-invoice in financial year, this was financial year 23-24, therefore 30th November 2024. But if you have raised the invoice in financial year 24-25, it will be, because May 24, though the gap is only 3 months, May 24 is financial year 24-25. It would be 30th November 2025. So this is the entire clarification given by this circular that we have discussed. Right. Circular number 211/5/2024. It has connected many provisions, and additional point is, if at all you have raised the self-invoice late, you might also be additionally liable for penalty, that is 122. So it is not only interest, that may be also penalty under section 122. So you may end up paying RCM with interest, and there may be a penalty under 122, but we will claim only the tax portion. Now, the next circular, which is circular number 219/13/2024, 219th overall circular and 13th circular of 2024. It is actually a very basic question, very basic doubt, whether ITC is available on ducts and manholes used in network of optical fiber cables, which is used by telecommunication companies. See, please understand the point. Whether, supposing there's a telecommunication company, Jio, and it has incurred expenses on ducts and manholes, which are actually used for what? Network of optic fiber cables. Nowadays, when you get all those 5G connection or even advanced connection, it is all optic fiber cables. So for that, you will be having ducts and manholes. There will be manhole, and inside that ducts will be also there. Can you claim the ITC? Now, please understand that here, why this question came up? Because there's a definition of plant and machinery when you see section 17 subsection 5, and that definition of plant and machinery for telecommunication companies tells that plant and machinery will not include telecommunication towers. Basically, you cannot take the credit on telecommunication towers. So doubt arises. On telecommunication towers, telecommunication companies cannot take credit. But can they take the credit on the duct and manholes, which will also be capitalized? Can they take the credit on that? So basically, when you talk about telecommunication companies, whether it is telecommunication towers or whether it is ducts and manholes used in network of optic fiber cables, both will be capitalized. Both will be capitalized. Right? In very normal language, both are in fact plant and machinery. But as per GST law, as per explanation to section 17 subsection 5 block credit, telecommunication towers will not be treated like plant and machinery. It will be treated like a civil structure, and civil structure, if at all it is capitalized, what will happen? you will not get the credit. Only on repair and maintenance of telecommunication towers you will get the credit. Otherwise, if it is capitalized, you will not get the credit. Now the same doubt came. Okay, telecommunication towers is excluded from the definition of plant and machinery. What about ducts and manholes which are used in network of optic fiber cables? Here clearly plant and machine definition does not removes it, and they are clearly used for making your outward supplies. That being the case, ITC on the same would be allowed. Right, this entire discussion is based on your section 17 subsection 5 definition of plant and machinery, which is attached as an explanation to section 17 subsection 5. So here very clearly you can take the credit. So telecommunication companies, say for example Jio. So when you talk about Jio or Airtel or any such telecommunication companies, if it is telecommunication towers which is being capitalized, it is removed from the definition of plant and machinery. It will be categorized as immovable property, normal civil structure, and when it is capitalized, you don't get the credit. But when you talk about your ducts and manholes which are used in network of optic fiber cables, it is clearly within the definition of plant and machinery. Moreover, when it is used for making your outward supplies, and ITC will be available. So this has been clarified here in this particular circular. Now, the next circular, which is circular number 231/25/2024, that is 231 overall circular, and for 2024 it is the 25th circular. What is the situation of ITC with respect to demo vehicles? Now, demo vehicles generally are used by authorized dealers in their sales outlet so that they can provide the trial run for those who are coming and seeing the cars and those who are intending to purchase the cars demonstration purposes. They will be there for trial runs. If you want to drive and see, if you have any issues, you can tell whether you will find whether that is comfortness or not, etc. So these vehicles are basically purchased by the authorized dealers from the manufacturers against tax invoices, and they will be shown as capital assets in their books of accounts. And finally, after the mandatory period, they have to keep that for mandatory period, they may be sold at a written down value on payment of applicable. When finally they can sell it, when they sell it, they'll be paying the applicable tax. So this is the background. Whether ITC can be available on demo vehicles is the basic question. So the basic question which arises is whether ITC on demo vehicles will be available, assuming the fact that the seating capacity is not more than 13 persons and it is motor vehicles for transportation of passengers. So basically, whether ITC will be available. It is a motor vehicle for transportation of passengers. If the seating capacity is more than or equal to 14, then clearly it is available. But seating capacity is less than or equal to 30. So seating capacity is less than or equal to 30. Can you take the credit? Now please understand, if the seating capacity is less than or equal to 13, you can take the credit only in 3 situations. Basically, you cannot take the credit 3 situations. If it is used for further supply of such motor vehicles, which means the authorized dealers like we are talking about, or when you are into transportation of passenger sector, or when you are into training sector, imparting training on driving of such motor vehicles. So normally, in a normal situation, when you're talking about purchasing a motor vehicle where the seating capacity is less than or equal to 13, you won't get the credit. But only in these exceptional cases, you get the credit. Obviously, when you talk about authorized dealers, you are not covered by this category. Transportation of passengers, they are not covered by transportation of passengers. They are not covered by training or imparting training on driving of motor vehicles. They are not into that sector. They are not into transportation of passenger sectors like the way you have Red Taxi or any other taxi company. They are not into training on the driving of motor vehicles. No. The question is, they are in the sector, further supply, which means authorized dealers, they'll purchase, they'll sell. Purchase, sell, further supply. And the very interesting point is, the term uses further supply of such motor vehicles, not the said motor vehicles. The very important point that you need to focus is, they've used the term further supply of such motor vehicles, not that motor vehicle. Supposing an authorized dealer has purchased 100 motor vehicles and he is going to further supply the same 100 motor vehicles. So there will be purchase and there will be sale of all these 100 motor vehicles. Therefore, you can clearly, categorically, you can tell that yes, ITC should be allowed because you're going to pay output tax. But in this case, the same authorized dealer purchases one demo motor vehicle, which will not be sold immediately. It may be sold later. When it is sold after the mandatory period, he will pay output tax. This will be sold later. And whenever it is sold, obviously, whenever it is going to be sold, output tax will be payable. But it is not going to be sold immediately. In other cases, for the 100 motor vehicles, they are purchased for selling it for further supply. Therefore, you will get the credit. You are going to pay output tax surely. Therefore, you can get the credit when you at the time of purchase. But for this demo vehicle, which is purchased now, it will not be sold now. It will be sold later, and it might happen, might not happen. And if at all it is sold later, you have to pay output tax. That is also clarified. Now, in this case, whether ITC is available is the question. Answer is yes, it is available. It is not further supply of said motor vehicle. That is, this demo vehicle is not used for further supply of. It is not used for further supply of said motor vehicle. This demo vehicle is used for further supply of such motor vehicles. Now understand the difference. Using this demo vehicle, a lot of customers will come, sit in the demo vehicle, have a trial run, like the vehicle and purchase it. So this demo vehicle will in fact push the sales of other motor vehicles. So this particular demo vehicle is not going to be sold. This motor vehicle will not be sold immediately. It might be sold later. Forget about that later part. But this particular motor vehicle is used for further supply of such other motor vehicles. When I tell such other motor vehicles, what is the impact? So this motor vehicle is used for the supply of such other 100 motor vehicles. So it will help in selling those other 100 motor vehicles, because whenever a customer will come, he will sit in the demo vehicle, like the vehicle, then purchase that vehicle. So credit will be allowed. Credit will be very much allowed. You will get the credit. ITC will be allowed. You will pay output tax later, but now immediately you will credit below. Output tax may or may not be paid. So that is the clarification here. But at the same time, this ITC is allowed only for that demo vehicle. Supposing there is same authorized dealer is purchasing one more vehicle. For transportation of staff. Which should not be sold. It is only used. Later on it might be sold and all, etc. In such a case, there is purchase of this one motor vehicle for transportation of staff, which should not be sold. It might be sold later, and etc. In this case, ITC will not be allowed because it has got nothing to do with the business. Now differentiate both. When you talk about demo vehicle, using the demo vehicle, there will be sale of other 100 motor vehicles. But using this one motor vehicle, which is used for transportation of staff, it has got nothing to do with sale of. This has got nothing to do with sale of 100 motor vehicles. So here, here ITC will not be allowed. ITC will not be allowed. In this case, ITC will not be allowed. ITC is not allowed. ITC is not allowed. So your input tax credit would not be allowed. So this is also clarified in the same circular, that only for the demo vehicle credit is allowed. For this particular person, ITC is not allowed. Also, it is clarified that if this authorized dealer is not purchasing and selling these 100 motor vehicles. So what is said, for demo vehicle, we will allow the ITC. For a motor vehicle, which is used for, say, transportation of staff, we will not allow the ITC. even for demo vehicle, there are two categories. If the authorized dealer is involved in purchase and sale of other motor vehicles, then allowed. If the authorized dealer is merely an agent, he's just an agent, and he's not involved in purchase and sale of other motor vehicles. He's not selling it. It's just an agent. In such a case, it is not allowed. So let us understand this situation. Motor vehicle for transportation of stuff. So if at all you're talking about demo vehicle, which is purchased by the authorized dealer, which is used for the purpose of purchase and sale of other motor vehicles. So that will be used for further supply of such motor vehicles. Then in that case, ITC will be allowed. But if that same authorized dealer, though you may call it as authorized dealer, but technically he is only an agent, he's not purchasing and selling any motor vehicle, just showing the motor vehicle, he just get the commission. In that case, you cannot tell that this demo vehicle is used for further supply of such motor vehicles. And if at all this same authorized dealer is purchasing motor vehicle for transportation of its employees or staff, clearly, then ITC is not allowed. Why ITC is not allowed in this case? Because it is motor vehicle for transportation of staff members. It has got nothing to do with further supply of such motor vehicles. ITC will not be allowed. So what is the condition? If at all you are talking about an authorized dealer who has purchased the demo vehicle which is used for further supply of such means other motor vehicles, only in that case ITC is allowed. Here it will not be satisfying this criteria. In both these other cases, this criteria would not be satisfied. Whether you purchase a motor vehicle for transportation of passengers, they have got nothing to do with, the customers will not come and sit in that particular vehicle. So nothing to do with further supply of such motor vehicles. ITC is not allowed. Even when you talk about an agent who's not purchasing and selling other vehicles, it has got nothing to do with further supply of such motor vehicles. ITC will not be allowed. But in all the three cases, whatever is the case, when these motor vehicles are finally sold, any of these vehicles, they are finally sold, there will be output tax payable. So you have a provision, right? Section 18 has got a provision. Sale of capital goods and plant and machinery, you will have output tax payable, a special formula, tax on transaction value or ITC minus 5% per quarter or part of the quarter, whichever is you have to compare, and whichever is higher you have to pay. So that will be output tax payable, whatever is whether you take credit or not. So it is irrespective of the fact whether you take input tax credit or you are not allowed to take input tax credit. This will be the scenario, right? And please understand, for motor vehicle specifically, if you are not taking the credit, there is a notification that you have to pay output tax. First thing, you have to pay output tax. Output tax rule 18 and by section 18 and by a notification. So normally, if at all you have taken the credit, it is tax on the selling price or reduced ITC. ITC minus 5% per quarter or part of the quarter thereof, whichever is higher. If you have not taken the credit, then tax will be only on selling price minus your written down value as per your Income Tax Act, and if that is negative, no tax. So that also is all, this is all part of your valuation, but nevertheless I'm just telling this would happen. Output tax will be paid. How it will be paid and all is not part of the circular. You have to pay output tax. If you have taken the credit, if you have taken the credit, whenever it is sold, you have to pay output tax. Liability is there. If you have taken the credit, it is a different logic. So this, if at all you have availed the credit, then you will be required to go as per your section 18 read along with rule 40.46. So that would be giving you an answer like a tax on transaction value, that is selling price multiplied by the rate of tax, or ITC minus 5% per quarter or part of the quarter, whichever is higher. But if you have not taken the credit, there's a notification which gives a relaxation. What is that relaxation which it gives? Notifications of 2018. What is the relaxation that it gives? It tells that you pay tax only on selling price minus WDV value. Valuation will be not selling price. Selling price minus WDV value as per Income Tax Act. Supposing selling price is 1 lakh, WDV value is 80,000, you pay tax only on 20,000. But supposing selling price is 70,000 and written down value is 1 lakh, which means negative. Selling price is 70 and WDV is 1 lakh. If it is negative, don't pay anything because it will be treated as 0. If it is positive, pay on that. If it is negative, the value will be treated as 0. So that is this entire understanding. And also it is clarified that the fact that the demo vehicle will be capitalized has of no use. Even if it is capitalized, credit will be available. So the fact that it is going to be capitalized is of no use. Goods includes capital goods. And even for capital goods, if they are used in course or furtherance of business, if they are used or intended to be used in course or furtherance of business, credit will be allowed. So this entire thing is clarified. So first is all about ITC. Second is all about capitalization. If you are capitalizing, whether it will change anything, no. Even for capital goods, you get the credit. So that is all about this particular circular. Right. Now moving on to the next circular. The next circular talks about a situation where you're talking about life insurance companies where life insurance policies are given and one portion of the premium is not taxed because of your rule, valuation rules. This is explained in circular 214, overall 214th number, 8th circular of 2024. So what is happening is, in life insurance policy companies, you have valuation rules. In rule 32, sub rule 4, that is the valuation rules where you will remove the savings component. So this entire circular tells that LIC company will pay tax on premiums, on your premiums. Premium contains risk portion plus savings portion, but assessable value will be only the risk portion. So this is clarified in your rule 32 sub rule 4. Now how to calculate risk portion? That is valuation mechanism. It may be the actual risk portion or notional risk portion. So there are some percentages also given, but the understanding is savings portion is nothing but time value of money, remove it. Savings portion is nothing but time value of money, remove it. GST will be paid only and only on the risk portion as per rule 32 sub rule 4, valuation mechanism. If you know the actual risk portion, that value, if you don't know, there are some mechanisms, some percentages will be fixed. Now here the doubt comes that supposing LIC, total LIC is 10,000, risk portion is say about 4,000 and savings portion is say about 6,000. GST will be there only on 4,000. GST will not be there on 6,000. So this is the background. So in life insurance companies, you will pay premium, but and this premium contains risk portion and savings portion. And as per valuation rule 32, only the risk portion will attract GST and the savings portion will not attract GST. The question is whether the savings portion, which does not attract GST, is to be treated as exempt supply or non-taxable supply, and if at all it is so, whether proportionate ITC has to be reversed. Now the answer is simple: no, it is not treated as exempt supply or non-taxable supply. It is only deduction from value. It is only deduction from value. The taxable portion is only that much. and if at all it is not treated as exempt supply or non-taxable supply, because definition of exempt supply is not this. Supply is taxable. Supply of life insurance policies where premiums are being paid, it is taxable. Only one part is being taxed. Supply is taxable, but value is removed. Value will tax only 4,000, will not tax 6,000. So only valuation is changed. This entire transaction of premium is collected, the supply is taxable, but valuation portion, one value where you're talking about 6,000 savings portion, that value is removed. Supply is taxable, but value is removed, so it cannot be categorized as exempt supply or non-taxable supply. When it cannot be called as exempt supply or non-taxable supply in terms of section 2 of CGST Act, clearly proportionate ITC need not be reversed in terms of your rule 42 or 43. No need of that. The circular is quite simple. It is not exempt. So supply is clearly taxable supply. One part of the value is removed. Supply does not becomes exempt or non-taxable. Supply is tax. Non-taxable supply means no levy. Exempt supply means levy is that either it is nil rated or it is 100% exempted. So it is neither a case of nil rate, no, nor it is a case of 100% exemption, nor it is a case of non-levy. It is not covered in any of these points. So it is not an exempt supply or non-taxable supply. If that is the scenario, proportionate ITC need not be reversed. You artificial companies will take full credit. So that has been explained. And friends, the next circular, which is quite a lengthy circular but a simple circular, is all about your warranty. Warranty and extended warranty. This was already there in one circular. ITC and GST liability on warranty extended warranty. This was already there. Explained in circular number 195, 7th circular of 2023, overall 216, 10th circular of 2024. Now certain additions have been done by circular 216, 10/2024. So it was already there. Now certain additions have been done. Now what is the situation? We'll see point by point, and it's very simple. So you have to just focus on what is the situation. Now, whenever you're talking about warranty, if something happens with the product, either the entire product or the part would be replaced, and if at all it is requiring repairs, it will be done. So the original equipment manufacturer, the person who's manufacturing it, will give a warranty to the customer for replacement of parts and for free repair services during the warranty period without charging any consideration. Right. Now, the question is, when the first about the GST liability. So there is a manufacturer and there's a customer. The product is sold. The product is sold. When the product was sold, manufacturer paid output tax. Manufacturer paid output tax. But when the product was sold, selling price, your selling price was not mere selling price, it is selling price plus warranty charges. So output tax was paid on selling price plus warranty charges, both. Right. This is the first part of the transaction. Now after some time, there's some problem with the product, and there is free replacement of parts or repair services. Either it is free replacement of parts or basic repairs. So it has got some problem. Free repairs or free replacement of parts. Now the question is whether manufacturer should pay output tax. Now when I tell free, what is the meaning of this? When I tell free, it means I am not going to collect anything, zero. Now should the manufacturer pay output tax? No, because nothing is being charged from the customer. So when the product was sold, manufacturer paid output tax not only in the selling price but also on the warranty charges. Right. When there is free replacement of parts or free repair service during the warranty period, it's all during the warranty period. Manufacturer is not going to collect anything. He is not going to collect any amount. When he is not going to collect any amount, there's no need of any paying any output tax without consideration. There's no need of paying any output tax. Also, the corresponding items for free replacement of parts, there would be some parts or the entire item. When I tell free replacement of parts, it need not be only certain parts, it might be entire product itself. If there is a refrigerator, there may be free replacement of part of refrigerator or entire refrigerator can also be replaced. Now, when that item is being used, whether the manufacturer should reverse the ITC, because ITC was availed on these parts or the entire product, should the manufacturer reverse the ITC when this free replacement is given? No. Why? On this part or the entire product which is being replaced, which is being replaced, please understand, manufacturers already paid higher output tax at the time of supply. When he has sold the refrigerator, he has said that I am going to pay output tax not only on the selling price but also on warranty charges. So when he has paid output tax, he has paid on price plus warranty charges. By default, whether he is giving split up as warranty charges or not, he includes warranty charges. He would have calculated warranty. You don't assume that, sir, what if he has not given the split up of warranty charges? Whether or not he has given the split up of warranty charges, he has calculated that how many products would be replaced and he has included that portion. So he has already paid output tax. So when there is an actual replacement of a part or entire product, ITC on which is already availed, there is absolutely no need to reverse the ITC. So two things we are understanding in the same example. First, should he pay output tax? No, free. It is free, you need not pay output tax. Whenever it is free, so normally what is understandable, whenever it is free, you have to reverse the credit. No, in this case, there's no reversal of credit. In this case, there is no reversal of credit. Basically, it cannot be seen in isolation. You don't see it in isolation. It is not a case of gifts of free samples. You don't tell that it is covered by gifts of free samples. No, it is not a case of gifts of free samples. When I tell I'm not paying output tax, the reason for not paying output tax is I've already paid output tax in advance. So when I'm telling I'm not paying output tax, it means I've already paid output tax in advance at the time of sale itself. And when I tell that, automatically, when I already paid output tax in advance, even for the free replacement of the part of the entire product itself, there's no need to reverse the ITC. So what we have understood is both the points. On the free replacement of parts or the entire product itself, no need to pay output tax, and correspondingly for that product or part, no need to reverse ITC. Obviously, if at all I have charged something, supposing if I have charged something, there is some consideration, there are some charges for that product or part of that repair service. If I have charged something, obviously the moment I charge something, I have to pay output tax. So if at all I have given it entirely, I have charged minimum amount, very small amount I have charged, very small amount I have charged. Normally if it is during warranty period, I will not charge anything. But if I have charged very small nominal amount, the moment I charge anything for that product or free replacement of product or part or for that repair service, on that small charge, whatever I have charged, I will pay output tax. So if it is free replacement of part of product or free service, repair service, no output tax. And even on the free replacement of product or part or entire product, no reversal of ITC. But if I have charged some amount, pay output tax on that some amount. So that is the entire circular. So we have discussed not only the first issue in the circular, but also the second issue in the circular. And the same thing is there in the third issue. What if the same thing was done by the distributor? So if at all consideration is not charged, then no GST is payable. If at all consideration is charged, GST is payable. Whether it is done by the manufacturer himself or the distributor, same concept. If I have done it free, it is not directly via manufacturer, it is via distributor, same thing. So here, what I can do, whether it is manufacturer or whether it is distributor, right? If it is free replacement of parts including entire product and free repair services, don't pay output tax. Also, no need to reverse ITC, and if it is some charges, pay output tax. So that is issue 1, 2, and 3 altogether. Now, issue 4 is very, very critical. Now, what is this issue 4? Now, issue 4 talks about what happens when distributor comes into picture. Why he'll give free? Because when he's giving free, technically, why he should give free? As I said, when a distributor is giving to the customer free, no output tax. Same scenario. If he's charging something, pay output tax. But why will he give free? So what actually happens? So there is a manufacturer, there's a distributor, there's a customer. So manufacturer sells to the distributor and distributor sells to customer. Manufacturer pays output tax, distributor takes ITC. Distributor will pay output tax, and obviously if customer is eligible, he may or may not take ITC depending on his eligibility. Right. Now, there is a free, later on there is free replacement of parts. There is free replacement of parts. It can happen through many channels. First, situation 1. Manufacturer, distributor, customer. Distributor gives it free to the customer but charges from manufacturer. Charges from manufacturer. So distributor will not collect anything from the customer, no output tax. When he's charging from manufacturer, distributor will pay output tax and your manufacturer will take input tax credit. Because he is a recipient. He is a recipient. Now supplier is the distributor. Supplier is the distributor. Supplier is the distributor because he is supplying, he is giving it. Out of his own stock, he is giving it. If that happens, supplier is the distributor, recipient is the manufacturer. Though it is given to the customer free, but who's going to pay? Recipient means person who's liable to pay. Person who's liable to pay. Who's paying? Manufacturer will pay. So that is the first scenario. The distributor will pay output tax because he is going to collect it from the manufacturer, and the manufacturer will take input tax return. Right. Second situation. Distributor will give free out of his old stock. Old stock of manufacturer. Right. Free. And manufacturer for this will give a credit note. Because he need not, he is already having a running account. He will give a credit note. Now, what will happen is, when manufacturer gives a credit note, manufacturer is the supplier, distributor is the recipient. So supply was already made, from that supply, output tax was paid, distributor take the credit and distributor give it free of cost. So whenever it is free to the customer, no output tax. Now what will happen? When credit note is given, your manufacturer will reverse the output tax and distributor will reverse the ITC. So distributor is not worried. Okay, you give me the stock. I am giving the stock free to the customer. You give me credit note. See, there are two ways. Either distributor charges it from the customer, where distributor gives tax invoice. So this distributor is giving tax invoice. Here, manufacturer is giving credit note. So if distributor gives tax invoice, distributor will pay output tax and manufacturer will take the credit, though the goods are going to the customer, because recipient is the manufacturer. Or manufacturer tells that you give from your stock, I'll give you credit note. I will reverse my output tax. You reverse your ITC. A third situation may arise. Manufacturer, distributor, consumer. Distributor is giving free out of the old stock of manufacturer. So in all the cases, obviously distributor is giving free out of the old stock of manufacturer, purchase from manufacturer, not of manufacturer, old stock purchase from manufacturer. So rather than writing old stock of manufacturer, better it could be written as from the old stock, obviously purchased from the manufacturer. Now what is happening is manufacturer will give new stock. Manufacturer will give new stock, but under delivery challan. Whatever stock you have given, I'll give under new stock. Now here nothing will happen. Neither manufacturer will pay output tax. Obviously there's no question of taking the credit. So manufacturer is not going to pay output tax. I'm not going to write output credit. Also do understand that in such a case, manufacturer need not reverse ITC. So this is also clarified. See, there are three ways. Either distributor gives stock free to the customer and charges from manufacturer by tax invoice. So distributor will pay output tax and manufacturer will take credit. Or manufacturer will give credit note to the distributor. So supplier is manufacturer, distributor is recipient. Manufacturer will reverse output tax, distributor will reverse ITC. Or manufacturer will give delivery challan and send a new stock. Now new stock will be sent under delivery challan. So whatever stock you have given free, I'll send you back the stock to the distributor. There's no supplier recipient. Now please understand, manufacturer will not pay any output tax. There's no question of trading any credit by distributor. Also understand that free stock which is being replenished is called as replenishment of stock. Whatever stock is given by the distributor to the customer free, again manufacturer is refilling that stock to the distributor, giving back that stock to the distributor under delivery challan. Manufacturer will not pay output tax. Also, it cannot be said as free samples because manufacturers, as we have already discussed, manufacturers already paid GST initially when the goods were sold, because selling price directly or indirectly, whether clearly or not clearly, which means whether by split up pricing system or consolidated pricing system, that selling price would have included warranty charges. So why is manufacturer not paying output tax? Because he has paid output tax earlier on warranty charges, and that free replacement will not have any reversal of ITC. So these are the three methods which are explained, categorically explained in this particular circular. So that is issue number 4. Issue number 5. Now, if at all this is also all about your replacement of parts. If at all free repass is given by the distributor to the customer without any consideration, and he is charging from the manufacturer, same thing. Now it is not about free replacement of parts or entire product, it is a free repair service. So distributor is giving free repair service to the customer but charging from the manufacturer, same thing. Now distributor becomes a supplier and manufacturer becomes a recipient. In such a case, GST would be payable by the distributor to the manufacturer. Why? Now it is not about replacement of products or entire part, it is free service. Distributor is giving free but telling that to the customer it is free, but it is collecting from the manufacturer, just like free replacement of parts first scenario. Now who will be the supplier? Supplier will be the distributor. Distributor will pay output tax. Who will be the recipient? Manufacturer. Can it take the credit? Yes, it can take the credit. It can take the credit. Now finally we are talking about the last part of the circular, which talks about extended warranty charges. What will happen with extended warranty charges? Now extended warranty could be categorized as two parts: at the time of supply or after the expiry of initial warranty, whether GST would be payable. Now this entire thing, please understand, whenever there is a supply, there are three situations which have been explained. Let us understand all the situations. First, the supplier is giving selling the product selling the product. And there is extended warranty. At the time of selling the product, extended warranty is part of it, which means the value would be selling price plus extended warranty charges. In such a scenario, it is nothing but composite supply, where the principal supply is sale of product, and extended warranty charges is only incidental or ancillary. So if in a situation where obviously output tax will be paid by the seller, not only on your selling price but also on extended warranty charges. Therefore, this entire concept is nothing but of composite supply, where the principal supply is that of the product and extended warranty charges is only incidental or ancillary. This is happening at the time of original supply itself. What if your supplier of product is different from supplier of extended warranty, which means warranty is given by someone else and product is sold by someone else? Now, in such a case, it cannot be called as composite supply. Why? Supplier 1 will pay output tax only on selling price, and supplier 2 will pay output tax on warranty charges. Both these supplies are made by two different persons. Therefore, calling it as composite supply will not work out. Composite supply is two or more supplies given by the same supplier. So this could not be categorized as composite supply for a very simple reason. Suppliers are different. So supplier 1 is selling the product, paying output tax on the selling price. Supplier 2 is giving the warranty, extended warranty, and this warranty charges is a separate supply, independent supply. So here, in the first case, when it is composite supply, what is the meaning? Principal supply was supply of goods. So entire supply was that of supply of goods. Here in this case, this supply is that of supply of goods, because supplier 1 is giving the product, and this supply is of supply of service. So rate will be different. Warranty will have a separate rate. When it is composite supply, on the entire value, rate will be that of principal supply. So here there was only one supply, composite supply, supply of goods. Only one rate. Here there are two supplies. One supplier, supply of goods, another supplier, supply of services. Both will have separate rates. So this was the first example. This is the second example. And the third situation. Supplier is selling the product initially. The supplier would have paid output tax on only selling price. Later on, the same supplier, after the initial warranty is over, the same supplier is giving extended warranty to her. It would be output tax on extended warranty charges. But what is different here is, this first supply is a separate supply of goods, and second supply is a separate supply, it will be supply of services. Though supplier is the same, it is not at the same point of time. Both are independent supplies. So in this particular scenario, the same supplier, initially when he is selling the product, he'll pay output tax on the selling price plus the initial warranty charges, not the extended warranty charges, supply of goods. Later on, the same supplier, this customer comes later on for the extended warranty after say a year or two. So same supplier will pay output tax on extended warranty charges. This will be treated as independent. Again, this cannot be categorized as composite supply. Why? Because though the supplier is same, but the contracts are different. At the time of supply, there was no extended warranty charges which was offered, or even if it offered, it was not taken by the customer. So it's not that. So the one supply will be treated as supply of goods, separate rate will be there, and after some point of time, the same supply to the same customer is giving extended warranty by collecting extended warranty charges. It will be supply of services. So please understand, whether it is initial warranty or extended warranty, it is only assurance service given. It is not for the product which is going to be replaced. So it cannot be treated as supply of goods. So when I'm charging warranty charges, something may go wrong, may not go wrong. I may replace your parts, I may not replace your parts, I may just repair. So this is only an assurance. It is not for actual replacement which will happen in future. So it is supply of service only. Supply of service only in this case. So these three situations are there. Why in the second case it cannot be called as composite supply? Because sale is done by one supplier and warranty is given by another supplier. Why in the third case it cannot be treated as composite supply? Because sale happens at one point of time and thereafter independently after few months or few years, extended warranty is given at a separate point of time. That is clarified in this particular last part of the circular. Now, talking about the last circular, where what is the background versus C? It is all talking about whether ITC can be claimed by insurance companies for the expenses which are incurred in repairing the motor vehicle in case of insurance claim settlement. So there's some damage in the motor vehicle and the customer is coming for insurance claim and insurance claim is given. But in the entire process, there are some expenses incurred by the insurance companies. Can it take the credit? So it is circular number 217/11/2024. 217th overall circular and 11th circular of 2024. So insurance companies who are engaged in general insurance services of motor vehicles, they will incur the cost of the repairs and damages and settle the claim either in two modes, either cashless mode or reimbursement mode. Either cashless or reimbursement. Under both the modes of settlement, one thing is common. Insurance company will account the repair liability and claim it as a cost, and that amount will be paid to the approved repair charges to the garage. Whether garage is their network garage where it will be cashless mode or other garage. In both the cases, invoices are generally given by the garage in the name of insurance companies. What happens in cashless mode? Insurance companies directly pays to the approved network garage. What happened in reimbursement mode? Payment of the cost will be first made by the insured person to the non-network garage, then subsequently insurance company will give that reimbursement to the insured. Now, what is happening? There is an insurance company, there is a network garage. Insurance company, non-network garage. First is a network garage. For network garage, it might happen in cashless mode. So, there is some repair services done by the garage. So, supplier is, in both the cases, supplier is garage. Now, what happens in network garage? Directly, insurance company repair services given to the insurance company and payment is directly made to the network garage. So, garage company will pay output tax and insurance company will take input tax. It is ITC is eligible. We're talking about insurance companies, ITC is eligible. We are not talking about normal companies. For insurance companies, there are exceptions. Whatever is the type of motor vehicle, whether it is less than or equal to 13 seating capacity or more than or equal to 13 seating capacity, for insurance companies, they can always take the credit. Now, what happens in case of non-network garage? Repair service is given to the insurance company, but payment, the insured person will make the payment to the non-network garage and this would be reimbursed by the insurance company to the insured person. Reimbursement model. So to the non-network garage, invoice will always be in the name of insurance company. Invoice will always be in the name of insurance company. But who will pay output tax? Output tax will be paid by the non-network garage. Can insurance company take the credit? Yes, because in both the cases, this is actually called as cashless mode. Cashless mode from the point of view of insured, or reimbursement mode. Reimburse mode is from the point of view of insured. So in cashless mode, insured will not be coming. So what will happen? Network garage directly will give the invoice to the insurance company. It will take the credit for repair services, and payment directly will be made by the insurance company to the network garage. Right, so in network garage will give invoice and payment will be made. In such a case, ITC will be allowed. Garage will pay output tax, ITC will be claimed. What will happen in reimbursement mode? The non-network garage will give the repair service. Insurance invoice will be in the name of insurance company, but the payment will be made by insured to the non-network garage. Then insurance company will reimburse to the insured person. Again, can ITC be availed? Yes, ITC will be availed only by the insurance company. Now, two other points of clarification which is given. What if I tell that invoice is not in the name of insurance company, it is in the name of insured? If invoice is not in the name of insurance company, ITC cannot be. One of the condition for ITC is invoice. So if I tell invoice is not in the name of insurance company, if invoice itself is not in the name of insurance company, then this entire discussion is of no use. ITC will not be available, because one of the condition for taking the credit is invoice should be in the name of recipient. Who is the supplier here? Supplier here is the garage. Recipient here is the insurance company. But if invoice is not in the name of insurance company cannot be said to be the recipient. ITC cannot be availed. So that is the last clarification which is there. And one more clarification is given. What if the non-network garage is giving the invoice to insurance company and partly to the insured, which means the invoice for the repair services, invoice is given in the name of insurance company, but insurance company is not making the entire payment. So that is the insured person which is coming in between. It is all reimbursement mode. Second mode, invoice is of say 1 lakh rupees plus GST. So supplier is non-network garage. Prima facie you feel that recipient is insurance company because but insured person makes the payment, but only partial reimbursement is there. So this 1 lakh plus GST, supposing GST amount is 80,000. Insured person makes the payment of 1,18,000, but reimbursement which is received is not 1,18,000. Supposing it is say 80%. 80% means 80,000 plus GST on 80,000 at 18%. So which would be your 14,400, because only 80% is given. Now, how much payment insured person paid? Entire amount, 1 lakh plus GST, 1,18,000. But how much reimbursement it got? Only 18,000 plus your 14,400. Now understand that supplier in this case would have paid output tax 18,000. But how much insurance company can take the credit? Insurance company can take the credit not of entire amount 18,000 but only of the reimbursement of 14,400. So in this case where supplier is paying output tax of 18,000 but the insurance company recipient can take credit only of 14,400 because only partial reimbursement is made. What about the balance credit 3,600? If insured company, insured person, the insured person is eligible for taking the credit, he can take it. But in such a case, he has to ask the non-network garage to give two invoices: 80,000 plus GST to the insurance company, 20,000 plus GST to the insured person. Only if the invoice is split, he'll be able to take it. That is not addressed in the circular, but that is understandable because one of the conditions for taking the credit is invoice. Right? If you don't have invoice and if you satisfy every other condition, credit will not be received. But the point here they wanted to clarify is supplier is paying entire output tax 18,000 on network garage, but insurance company will not take the entire 18,000 credit. It will take only proportionate credit because it has paid only 80,000 plus 14,400 GST to the insured. Insured person fully paid full amount, so it is only 14,400 credit. Can the insured person take the credit of balance 3,600? If entire invoice is in the name of insurance company, no. But if the non-network garage gives two invoices, one 80,000 plus GST to the insurance company will take the credit of 14,400, and second 20,000 plus GST 18% to the insured. Then the insured, if at all he is eligible, he can take the credit of 3,600. So that is explained in this circular, issue 1, issue 2 and issue 3. So these are all the circulars when you're talking about your ITC chapter. Yes friends, now let us discuss the circulars which are there in your IGST Act, basically dealing with your place of supply. Starting with your circular number 209/324, that is overall 209 circular, third circular of 2024. It talks about a new provision, section 10(1) CA, where place of supply is said when you're talking about supply to unregistered person. It is highly possible there where you're supplying to unregistered person, and they give one billing address but delivery address is other. So when you are supplying to unregistered person, so Mr. A, who's registered in X state, is getting an order from online platform of a new phone which is delivered in Y state, which means there is a supplier in Tamil Nadu. Supply is via electronic commerce operator, online platform. Recipients is giving billing address as Maharashtra state, but recipient is telling that you please deliver to delivery address, you please deliver to Delhi. So supplier will finally deliver to Delhi. Billing address is Maharashtra, but delivery address is Delhi. Now, as per section 10(1) CA, when supply is to unregistered person, place of supply is the state in which this unregistered person is the address of this recipient. Address of the, even if state is mentioned, it is sufficient. Address of the recipient. But now address of the recipient is two address. One is billing address Maharashtra and one is delivery address Delhi. Please understand that the circular has clarified that we are talking about destination based consumption taxation. The goods are delivered to Delhi. So you'll focus on delivery address and not the billing address. So what is not important? Your billing address is not important. Your delivery address is important. Rather, they have asked the supplier to, when they are preparing the invoice, they have asked the supplier to only give the details, rather for the purpose of place of supply, raise the invoice with the delivery address. They've asked the supplier to raise the invoice with delivery address. So invoice will be also against Delhi. And this IGST partly will be retained by central government and partly will go to Delhi state and not Maharashtra state. So that is clarified by this circular. Right. Now, the next circular deals with services. Place of supply, when you're talking about custodial services given by the banks to a foreign portfolio investor. The client is a foreign portfolio investor. So in next three circulars, they're all talking about foreign clients. So section 13 will be applicable. So this basically talks about section 13, circular number 220 overall, 14 circular of 2024, 220/14/2024. Now, when you talk about application of section 13, because it is a foreign client, then section 13 will be applicable. The question was, can it be fit under section 13 subsection 8, which talks about services given by banks to their account holders. Now, when you talk about your section 13 subsection 8, services given by banks to an account holder, place of supply shall be location of supplier, which means place of supply will be India itself. Supplier is in India, bank, recipient is foreign investor, foreign portfolio investor, which means the outside India, right? And what is the place of supply? Can place of supply be under section 13 subsection 8? No, because account holder means what? Account holder always means an account which is bearing interest to the depositor by way of having demand deposits or term deposits, but it also includes non-resident external accounts and non-resident ordinary accounts. So basically it talks about normal accounting services. Account holder means an account which bears interest to the depositor, be it term deposit or demand deposits, and it includes NRE account and NRO accounts. What are the normal services given by a banking company to an account holder? Normal services are that of opening and operation of bank account, including that of lending, depositing, safe deposit locker, etc., or transfer of money by way of telegraphic transfer, mail transfer, or electronic transfer, NEFT, RTGS, for which charges are taken. These are the basic accounting services given by the banks to account holder. Now, why is it not covered by section 13? We are trying to analyze. Because when you talk about special services like financial leasing services given by bank, or merchant banking services, or forex broking services, or money changing services, or portfolio management services, including fund management, pension fund management, custodial services, the services that we are discussing now, or depository or trust services. These are all services where you cannot tell that these services are given by bank to account holder. These are not normal services given by bank to accounts holder. So when you talk about section 13.8, it talks about services given by bank, ordinary services given by bank to their account holders. Now, this foreign client might have an account in the bank, but these cannot be said to be normal services given by banks or financial institutions to their account holder, be it all the specialized services, financial leasing services, merchant banking services, money changing services, portfolio management services, including fund management, pension fund management, depository trust services, custodial services. They are not normal banking services which are given to their account holders. They might be given to other than account holders, but they are not normal services. So it is pretty clear that when they are not normal banking services given by banks to their account holders, section 13 subsection 8 will not apply. When this will not apply, the case will go to section 13 subsection 2, where the place of supply will be determined by the default rule section 13 subsection 2, where it is a location of the recipient. And when it is a location of the recipient, what will happen? It is highly possible that it is export of services. Where is the supplier? Banks or financial institution which is in India. Where is the recipient? Foreign portfolio investor, supposing he is there in USA. Right. What are the services given? Custodial services. Is it covered by section 13 subsection 8? No. If it was covered in section 13 subsection 8, place of supply would have been location of service provider, which is India. But now it is very categorically clear that it is covered in section 13 subsection 2, where place of supply is location of service recipient, because the address is available in ordinary course of business, which is USA. So supplier is there in India, recipient is there outside India, place of supply is there outside India, and if the amount is received in convertible foreign currency, if you get forex, then it will be called as export of services. If at all place of supply would having location of service provider, which is India, then it was not possible for it to be export of services. Now it is possible that it is export of services, subject to the condition that all the other conditions are satisfied, subject to the condition that you get foreign currency. So that is the beauty of this particular circular. Likewise, the other circulars also are revolving on the same fact, where is the same place of supply and whether it will be export of services, which means they are only focusing on your foreign clients, section 13. So you are talking about advertisement services provided to foreign clients. Again, the focus is only on section 13. Circular 230, overall 24th circular of 2024. A foreign company is hiring an advertising company in India for advertising its goods or services, where there is a comprehensive agreement with the advertising company that it has to manage everything: media planning, investment planning, creating, designing content, strategizing for maximum customer reach, identification of to whom which media owner this work should be given, dealing with media owners, procuring media space for broadcasting on television or internet. This is giving all the services. This advertising agency is a one-stop solution which is outsourcing the entire activity. It's not only just connecting with the media house. It is very comprehensive agreement where proper planning, investment planning, creating the content, strategizing the maximum, how to reach the maximum customers, which media outlets we can reach for putting the advertisements, dealing with them, putting the advertisements for how many seconds, 30 seconds or 15 seconds, everything is given. Now, media owners will raise invoice on the advertising agency for the cost involved, and subsequently advertising agency will raise the invoice to foreign client and get the foreign exchange. So there are two contracts: media owners to the advertising agency to the foreign client. Media owners to the advertising agency and advertising agency to the foreign client. Now please understand, first it was evaluated. The focus is only on what? Advertising agency and the foreign client. Whether this is the supplier. Where is the supplier located? Media house is located in India and advertising agency is located in India, and let us assume that the foreign client is of the USA. And we are talking about what? We are talking about a scenario where supplier is in India, recipient is outside India. We are talking about this particular contract. We are not focused on media owner to advertising agency. Our focus is on the second contract, whether it will be export. Now, whether it will be covered in section 13 subsection 8, where the place of supply is equal to location of service provider. What is the understanding of section 13 subsection 8 in this case? Whether it will be categorized as intermediary. Please understand that this advertising agency is not only doing the role of intermediary. Intermediary is just connecting the two persons and going out. It will not provide anything on its own account. Rather, if you see the definition of intermediary, you will clearly understand intermediary. What is intermediary? Intermediary is actually defined. Intermediary is not giving the service on his own account, not giving the services on his own account. Here it will not fulfill the category or the role of intermediary, because it is giving the services on their own account. Rather, only one of the services is identification of media outlet or media owners, and they'll post it. They have to do a lot of other works. They have to plan the media campaign, they have to plan the investment which is required, they have to see how maximum content, maximum customers will reach, they have to see the design, fulfill the design, they have to deal with the media owners, negotiate with them, etc, etc, etc. So please understand that when you talk about an intermediary, a person who arranges or facilitates the main supply of goods or services between the two persons, and it is not involved in the main supply on his own account. But in this case, advertising agency, though the name is agent, but it is providing the entire bunch of services on its own account. So it cannot be termed as intermediary. It cannot be termed as intermediary. Therefore, section 13.8 is not there. Place of supply is not location of. It is not location of your service provider. Now, can it be said that place of supply? So first point is rule out, it is not acting as an intermediary. Second point, can it be said that the place of supply for such advertisement services is covered by section 13, performance based. Performance based. In performance based, there are two categories. Either you have to perform on goods which are physically made available by the recipient. Please understand that in this case, there are no goods which are physically made available. So ruled out. Second, that performance is on a person, physical person, either on the recipient or person acting on behalf of the recipient, where it requires the physical presence of the individual. Now please understand that here it does not require the physical presence of the individual. Foreign client is not at all required. So so they evaluated the circular with another point, that can it be fixed under performance based, section 13 subsection 3, where place of supply is equal to location of performance, and performance is in India. Now please understand, performance should be on goods, there is no goods involved, or on the persons, there is no need of physical presence of the persons. So section 13 subsection 3 is ruled out. Now also there is an issue raised up, who will be the acting as recipient? Whether recipient will be foreign client or recipient will be representative in India, that of foreign client. It is very clear from the definition of recipient that recipient means a person who is liable to pay the consideration. Please understand, the contract is with the foreign client. Representative in India is just an employee of that foreign client, so that is not the recipient. Whether recipient means the target audience. Obviously, recipient does not mean the target audience, end customers. No, recipient means the foreign client. Why? Because what is the definition of recipient? A person who's liable to pay consideration. Who's liable to pay consideration? Foreign client. Your Indian representative is not liable to pay the consideration. Target audience are the beneficiaries. They are not liable to pay the consideration. No. So that is clarified. So supplier is in India. Recipient is a foreign client, is outside India. Supplier is in India. Recipient is the foreign client, which is USA, not the representative of a representative in India or foreign client. No, not the target audience. Where is the place of supply? Place of supply is neither covered under section 13 subsection 8 nor covered in section 13 subsection 3. It is covered by the B default rule. If it is not covered anywhere, default rule, where place of supply is location of recipient, because it is available in ordinary course of business. You know the address of the foreign client, which is USA. So here place of supply is USA. Why I'm telling this? Because if place of supply is USA, you satisfy every condition of export. Supplier is in India, recipient is outside India, place of supply is outside India, and if at all convertible foreign currency is received. One more condition, if at all foreign exchange is received. If at all foreign exchange is received, additional condition, supplier is in India, recipient is outside India, place of supply is also in India, also outside India. Only one extra condition, if convertible foreign currency is received, it will be surely treated as export of services. So condition number one, supplier is in India. 2, recipient is outside India. 3, place of supply is outside India. 4, it is foreign currency is it will be treated as export of services. If at all place of supply was under section 13 subsection 8, your location of service provider, or section 13 subsection 3 performance, then might be it is not covered by it might not have been export of services. But now this is a case where it would be covered by export of services. This is the entire circular. It seems lengthier, but it's not so. And the last circular is also in the same line, exactly same line. Ditto, same line. Now, please understand what is the subject matter. We are talking about data hosting services by a data hosting service provider to cloud computing service provider. So, data hosting service provided by a service provider in India to a cloud computing service provider who's located outside India. So, this is clarified in circular, overall circular 232, 26 circular of 2024. So, what would be the place of supply? Who are all involved? Data hosting service provider in India, cloud computing service provider, and that is end user. Please understand, we are talking about the first contract, end user. So our focus is on the first contract, data hosting service provider and cloud computing service provider. So data hosting service provider is the supplier. Let us assume that supplier should be in India, and cloud computing service provider, this is the recipient. Recipient is outside India. Suppose you are talking about USA. So supplier is in India, recipient is outside India. Now, when you talk about data hosting service provider, they will host the data. Now, what actually happens? Cloud computing service provider, let us take an example. Say, for example, you're talking about certain online classes, certain softwares, where you're playing or you're taking classes of some person who's located outside India. Supposing my classes are hosted on Aride, say cloud computing service provider. Let us assume that Aride is not in India, Aride is outside India. You are the students, you are the end consumer using that. Let us assume that this particular cloud computing services you'll be using, they'll use certain various apps, and they'll be the end user will be using cloud computing services to do various activities like watching videos or doing some programs or doing an activity or playing, etc. etc. Now, data hosting service provider will give a lot of services. Right, they'll save the data, all the data which is required for the cloud computing. Cloud computing service provider might not have their own space for saving the data. So they will not only save the data. If you see, look at the services given by them. Data hosting service provider will give a lot of services to the cloud computing in terms of data storage, analytical, artificial intelligence, machine learning processing, data analysis, development services. Now this service is given not by data hosting, this service is given by cloud computing service provider, is giving the services to the end users for what? Storing data, analytics, artificial intelligence. So they are giving customized services. They are using the services of data hosting service providers, and they'll be giving a lot of services: data storage, analytics, artificial intelligence, machine learning processing, etc. etc. Now, what are the services given by data hosting services? Now, data hosting service provider will provide a lot of services to the overseas cloud computing service provider. Not only for saving the hardware, it will have essential infrastructure, it will have a premises, a lot of hardwares will be there, a lot of person will be there to have the hardware for security purposes. Also it is not only the hardware, premises, hardware and person, it is also other services like ventilation services, proper AC, uninterrupted power supply, software, network connectivity, security protocols, which are owned by the data hosting service providers. So they'll give a space not only for storing the data, it is not only a premises for keeping the hardware, so certain persons will be there at the data center. No, not only that. Other services like ventilation, cooling services, proper power supply, internet connectivity, software, network connectivity, security protocols. These all services are given by data hosting service provider to the cloud computing service provider, and cloud computing service provider in return will give customized services in terms of storage, analytics, artificial intelligence, machine learning programs, processing, etc., etc. Even watching the videos, playing the games, etc. That will be given by them. Now, please understand that. This particular service, it is cloud computing service provider will take the services of data hosting service provider and give the product to the end users. Now understand that place of supply for them will not be under section 13 subsection 8. It is not location of service provider. Data hosting service provider cannot be called as an intermediary. They're just not connecting, they're just not giving a base to them for providing the services. So they cannot be called as an intermediary. Therefore, section 13 subsection 8 is not applicable. Place of supply is not location of service provider. So data hosting service provider will give obviously basic premises. There will be hardware, person will be there, security person will be there, employees will be there, but also other services, proper ventilation, power supply, internet connectivity. There are a lot of other things that will be provided by the you will have proper security protocols, etc. All these services will be given, and cloud computing service provider to the end user will give the end product, right? Analytics or machine learning programs or processing, certain other activities they can do. Now please understand, you cannot tell that data hosting service provider is only an intermediary between cloud computing service provider and the end user. So section 13.8 will not be applicable. They cannot be called as an intermediary because they are providing a lot of services on their own account. So they are providing services on principal to principal basis. They are not acting as intermediaries. Now, can it be said that the services which are provided by them are in form of immobile property related services? So that was the next question asked. Can you tell that these services given by them are acting as immobile property services? Please understand that data hosting service provider, obviously the main services, they'll have their premises, whether it is owned or leased, but that is not the only service. They give a lot of other services. Like discussed, their role is not only merely giving the premises for storing the hardware, having the personal itself, but also a lot of other services, ventilation, cooling system, power supply, network connectivity, software, security protocols, etc. So a lot of other things are going there. So the services which are given by data hosting service provider cannot be said to be services directly in relation to immobile property. It cannot be said to be indirectly, because when you talk about section 13 subsection 4, it should be directly in relation to immobile property. So place of supply will not be location of immobile property. It's not that place where the data hosting is being done. It's not that property. No. It's not directly in relation to immobile property. Now what is left out? In this case also, place of supply will be governed by general or default rule. Section 13 subsection 2, where place of supply will be location of service recipient as it is ordinary available, and recipient is located in USA. And if you see in all above cases, we finally understood that it is location of service recipient, default rule. So supplier data hosting service provider is in India, recipient cloud computing service provider is outside India, place of supply is outside India. It is not covered by section 13 subsection 8 because it cannot be called as an intermediary. It is not covered by section 13 subsection 4 because it is not directly in relation to import property. So place of supply is outside India, and it would be qualifying as export of services with additional condition that it has to get foreign currency. So condition number 1, supplier is outside India. Yes. Condition number 2, recipient is outside India. Sorry, supplier is in India. Yes. Recipient is outside India. Yes. Place of supply is outside India. Yes. And if convertible foreign currency is received, then it will qualify as export of services. So that is about data hosting service provider. We are talking about data hosting services, not cloud computing services. Our focus was on data hosting services. So that is all about the circulars dealing with your IGST Act. The first circular was all about goods, section 10(1) CA, but all the other circulars, they're all about Indian suppliers and foreign clients, and whether place of supply is governed in section 13(8) or section 13(3) or section 13(4). No, in all the three cases that we have discussed, finally it was decided that place of supply is section 13 subsection 2 default rule, where it is location of service recipient, and if supplier is in India, recipient outside India, place of supply outside India, if you get convertible foreign currency, it will qualify as export of services. So that's all about the circulars of your IGST Act. Yes friends, now let us move on to circulars on your refund chapter. Even 2 circulars are in your appeals and revision chapter. A very basic and simple circular has come out in your refund chapter, which deals with downward revision of price as an amendment with respect to upward revision of price in case of export of goods. Now it is downward revision of price in case of export of goods. So circular 226/20/2024, overall 226 circular, 20th circular of the year 2024. Now assume that there is export of goods, and we are talking only about a situation where the supplier has gone for payment of IGST, subsequently got the refund of IGST, automatic refund. Right? Pay and get the refund. He has not gone for LUT or bond. We are not talking about LUT or bond. Now, there is an amendment which has been provided both in terms of Rule 96 read along with Rule 95. It has been provided that if at all there is upward revision of price subsequently for those export of goods, you have to pay additional IGST, and you will get the refund of that additional IGST. But this will not be automatic. For this you have to give an application. You have to file a refund application. This will not be automatic. So this is provided, and this should be within 2 years from the relevant date, that is 2 years from the date of export. Now that particular amendment did not touch anything about downward revision. Now the circular is saying that if there is a downward revision of price in relation to export of goods, it is not talking about any payment or reversal, but it is telling that make sure that you have received an extra refund earlier. You have to take the linkage from the first part. You have received the extra refund earlier. Now what you have to do, you have to repay that refund back. Repaying. Here the first part was all about refund. Second part is all about your refund. Now what is said is you have to repay that erroneous refund, or you may not call it as extra refund. Repay that refund amount. You have got the refund of IGST, you repay that refund amount. Now the circular is just touching the fact that if at all there is downward revision of price in export of goods, initially what has happened, the goods were exported, you paid output IGST, you got the refund of entire amount. Supposing output IGST you paid 1 crore, you got the refund of entire 1 crore, which was automatic. Now because of downward revision of price, supposing the tax amount is say 10 lakhs, you have to repay. You have got 1 crore. This is GST amount. GST amount you paid 1 crore. GST amount you got back 1 crore in your bank account. Now, if at all, because of downward revision, GST amount is say 10 lakhs. So 10 lakhs refund that you have got has to be repaid back. The circular doesn't touch us. Can I reverse it? Can I reverse the payment? My output payment? Yes. I can reverse my output IGST in my return, if at all other conditions are satisfied. So what I'll do, I've paid GST 1 crore and I've got the refund of 1 crore. Now can I reverse GST? Yes, I'll reverse GST of 10 lakhs and I'll repay that amount. But let us only focus on circular. What the circular tells? Circular tells that if there is a downward revision in price after export of goods for which you have gone on payment basis and got the entire refund, you repay the proportionate refund of IGST in proportion to downward refund. Proportionate. Say 10% is downward revision. So what refund you claimed? 1 crore. 10% is downward revision means 10 lakhs you repay that particular amount. So this is the circular in your refund chapter. Now moving on to the circular in appeals and revision chapter. The first circular is only a monetary limit. Now government has fixed a monetary limit for filing appeals by department. Appeals or application by department. For SSC there is no restriction. It is filing of appeals or application by department when they are going to tribunal, High Court or Supreme Court. This has to be read along with section 120. Now when you talk about fixing the monetary limit, this fixing of monetary limit, this is an instruction only and only given on department. If department is going to tribunal, High Court or Supreme Court, they have to see whether it is reasonable amount. So this is explained in circular 207/1/2024. That is 207 circular overall and first circular of the year 2024. Monetary limit for the department. It is not for SSC. SSC can go anytime. It's not for the SSC, only for department. If at all department is going to appellate tribunal, amount should be 20 lakhs or more. Then they can file an appeal. So if department are going to High Court, amount should be at least 1 crore or more. Then they can go. If department are filing an appeals or application to Supreme Court, amount should be at least 2 crores. At least 2 crores. For tribunal, 20 lakhs. For High Court, 1 crore. For Supreme Court, 2 crores. This is all about department. If department wants to go to tribunal, see that the amount is 20 lakhs. If they want to go to High Court, see that the amount is 1 crore. If they want to go to Supreme Court, see that they want to go to see that the amount is 2 crores. This is only for department appeals or application. It is not for SSC. But understand how you are going to see this 20 lakhs, 1 crore or 2 crores. If the dispute pertains to a demand of tax with interest or without interest or with penalty or without penalty. So there is a tax. It may be with interest penalty. It may be without interest penalty. Then you only see the tax portion. You only see the tax portion. Don't consider interest penalty. But if there is a dispute dealing only with interest, so when you are saying that 20 lakhs, 1 crore or 2 crores, see only the interest. If there is a dispute dealing only with penalty, then for 20 lakhs, 1 crore, 2 crores, it is penalty. If there is a dispute which deals only with late fees, then for 20 lakhs, 1 crore, 2 crores, see only that particular late fees. But if there is a dispute dealing with interest, penalty and late fees, tax is not there. If tax is there with interest, penalty, late fees, see only the tax. But if tax is not there, it is interest, penalty and late fees. Now see the aggregate total of interest plus penalty plus late fees. If it is tax with interest, penalty, late fees, only tax. Only interest, see interest. Only penalty, see penalty. Only late fees, see late fees. But if it is interest, penalty, late fees, no tax, then see the total of interest, penalty and late fees, whether it is crossing 20 lakhs or 1 crore or 2 crores. If the matter is dealing with erroneous refund, see only the refund amount, only the tax amount. CGST, SGST, IGST and compensation cess. Total tax amount. When I tell tax, I should not see only one tax. Total tax amount. CGST plus SGST plus IGST plus compensation cess. If, and last is a very special case, if there is a composite order where it involves more than one notices demand or more than one appeals. There are 10 demand order for which one appeal is filed, composite appeal, or 10 appeals at appellate authority level for which one appeal is filed at appellate tribunal. So if there is a composite order which is taken to higher authority, but the matter deals with multiple demands or multiple appeals where one appeal is going ahead, in that case you have to see total of all the appeals and not individual appeal or demand notices. So if there are 10 demand orders for which you're going to go for a common appeal in appellate tribunal, each of the appeal, the amount is less than say 20 lakhs. But overall, for all the 10 notices together where you're going to go to tribunal, it is more than this 20 lakhs. So you have to see overall. And overall of what? Depending. If the matter deals with tax, with interest, penalty, late fees, only tax. If the matter deals with only interest, only interest. Only penalty, see penalty. Only late fees, see late fees. If it deals with interest, penalty and late fees, see all of them put together. Now, what is this point? If there are multiple demand orders for your filing a common appeal, so you're taking a single appeal to appellate tribunal. There are actually 10 appeals in appellate tribunal, appellate authority, but you're filing a single appeals in appellate tribunal. Appellate tribunal limit is 20 lakhs. So if you see individually all these demand notices or appeals, the amount is less than 20 lakhs. But if you see all together, because now you're going to appellate tribunal together, so you have to see jointly. You have to see jointly and not individually. But when you see jointly, depends what you have to see, whether you have to see only tax or only interest, that we have already discussed. And whenever you're seeing the monetary aspect, you only see the disputed amount, not the total amount. Only see the disputed amount and not the total amount. Now this is when monetary limit is applicable. When you are not required to see monetary limit. In few cases, decision to file the appeals shall be taken on merits irrespective of monetary limit, which means whatever monetary limits we have discussed, it will not be applicable. Department can file the appeals and application to appellate tribunal, High Court, Supreme Court, ignoring these monetary limits. What are they? If any provision of the Act is ultra vires the Constitution, forget about 20 lakhs, 1 crore, 2 crores, go to Tribunal, High Court or Supreme Court respectively. If any rules or regulations is ultra vires the Act, if Act is ultra vires the Constitution, if rules regulations are ultra vires the Act, or any order, notification, instructions or circular is ultra vires the Act, rules or regulations. So if Act is overriding Constitution or rules regulations are overriding Act, or orders, notifications, instructions, circulars are overriding the Act, rules and regulations, then you can go. Or if the matter is dealing with valuation or classification or refund or place of supply, 4 important matters: valuation, classification, refund or your place of supply, or any other issue also finally they are given. But first 4 matters are very clear: valuation, classification, refund and place of supply, where they are recurring in nature. It will come again and again. Same issue will come back again and again when it is valuation, classification, place of supply and refund. And it involves interpretation. So where it is recurring in nature and it is involving interpretation, then you go. Either it is recurring in nature or it involves interpretation, question of law, or under or. Either it is repeated in nature or it involves interpretation. You can go, department can go on appeals to Tribunal, High Court, Supreme Court. It is ignoring 20 lakhs, 1 crore and 2 crores limit. Or where there are any adverse comment given or in the cost which are imposed against the government or departmental officers, where any authority has passed any adverse comments and put a cost against the government or departmental officer, which means they have done something and there are adverse comments put by some authority. Appellate authority has said something wrong about the departmental officers or has imposed some cost on departmental officers, ignoring the 20 lakhs, 1 crore, 20 lakhs, 1 crore, 2 crore limits, they can go for appeals because it is against them. But there is any adverse comment or cost against either the government or department or their officers, it is now about their self-respect. They can or any other case which the board may notify in the interest of the justice. And whenever department is not filing the appeals because of the monetary limits of 20 lakhs, 1 crore and 2 crores for tribunal, high court and supreme court respectively, section 120 categorically tells that it will not have any precedent value. And it tells that reviewing authorities who are telling that not to file an appeal should record that even though just decision of the lower authority is not acceptable, we are not filing appeal as the amount involved is less than the limit fixed by the board. And in such a case, when department is not filing an appeal because of the monetary limits, next time when the same issue comes up, can department take up the matter? Yes, because that time that particular case, the amount may exceed the monetary limits, or it may involve question of law. Alright. Also, it is said that when no appeal is filed by the department because of this monetary limit, DR, department will always be fought by departmental representative of council, should make every effort to bring in front of tribunal or court that appeal was not filed only for the reason of monetary limit, and it should not be taken that department has accepted the judgment of the lower authority. So this is all given in section 120. Simple language. If department is not going for appeal or application because of the monetary limit, it doesn't mean that department has accepted their defeat. They might still strongly believe that they have a very strong case, but they are not filing because of the monetary limit. So that should be put on records by the reviewing authority. Also, DR should take an effort that it is put on records, so that next time assessee should not tell that, see, last time on the same matter you accepted your defeat, now why are you bringing that issue again? Department can bring that issue again, and if that time the amount is more than the limit or it involves question of law, they can go further to tribunal, high court and supreme court. So that is this scenario. Now the next circular, rather the last circular of appeals and revision of, and last circular overall, when you're talking about appellate tribunal, supposing you have filed in first appeals, and first appeals you have lost the case, assessee has lost the case. Now appellate tribunal is the next step for assessee. If assessee has lost the case in appellate authority, he will go to appellate tribunal. But the problem is appellate tribunal is not into force. It is not yet effective. You don't find appellate tribunals there in states. So officer will start recovering the dues, because if you're not filing the appeals to the appellate tribunal in the given time, then recovery will start. Your recovery will start. Now, circular 224/18/2024 has given some clarity on it. So if assessee has lost the case in appellate authority and he wants to further fight the case in appellate tribunal, but appellate tribunal is not at all there, and if he is not filing the appeals in appellate tribunal within the time limit given, department will start forceful recovery. Now, what is the remedy overall? Assessee has to do two things, because assessee has fought the case in appellate authority, lost the case there. Now he wants to go to appellate tribunal, but appellate tribunal is not there. So taxpayer has to make all the efforts to make the pre-deposit amount, whatever is there for appellate tribunal, right, within the amount. He has to go to services, ledgers, payment towards demand. There will be liability ledger part 2, where he can map the amount against a selected order which he wants to file it further in appellate tribunal and reduce the liability, which means if the liability is say 1 crore and 20% is a pre-deposit, pay 20% against it and wait till appellate tribunal is coming into picture. The amount deposited will be taken as pre-deposit when appeal is filed. So as of now, you cannot pay the pre-deposit. So what you do, as of now, they are given a temporary solution till appellate tribunal is given. So go on your portal, there will be services, ledgers, payment towards demand, electronic liability ledger will be there. Select that order against which you want to go to appeals to appellate tribunal. Against that, pay whatever is the pre-deposit amount paid. And when you file, actually appellate tribunal is formed, and when you file appeals, that amount will be adjusted against the pre-deposit. Understand that you need not remember what is the portal thing. In simple terms, pay required pre-deposit on portal. And not only that, you have to give an undertaking also, telling that we will file an appeals the moment we are agreed by the order of appellate authority. Will file an appeal to appellate tribunal. Moment appellate tribunal is coming into operation within the time limits of section 112. So when the appellate tribunal comes, they'll give an extended time limit, because as of now the time limit is different. When it actually comes for the very first time, they might give some special time limits. So that will be done. And on providing that payment and giving the undertaking, recovery of the balance amount will not happen. Actually, the moment you pay pre-deposit amount, recovery doesn't happen. But the problem is you cannot pay pre-deposit. Why? Because there's no appellate tribunal. So what to do? Against that order against which you want to file appeal to appellate tribunal, select that order in portal and pay the required pre-deposit, required amount. It will be treated as pre-deposit when you file an appeals. Not only that, give an undertaking to the department that the moment appellate tribunal is formed, within the time limit which is designed in 112, at that point of time we'll file appeals to appellate tribunal. When you do this both, there will be no recovery. And if at all the taxpayer is not making the payment or not giving any undertaking or declaration within the time limit which is required for going to appellate tribunal, it is presumed that he is not interested in filing an appeals. Recovery proceedings will start. Or when the tribunal is constituted and is not going for appeals, he has already paid partial amount as pre-deposit, and when the tribunal is actually coming into effect but he is not paying the balance, he is not filing an appeals within the timeline which would be given in section 112, at that point of time remaining amount will be recovered. So this entire circular tells that assessee is agreed by the order of appellate authority. Now he wants to go to GST appellate tribunal. Who? It is assessee. Assessee has lost the case and he wants to go. But the problem is appellate tribunal is not into effect. It is not at all that. So what assessee is required to do? Assessee is required to pay the amount of pre-deposit against demand. It will be treated as pre-deposit when actually appeals is filed, and give an undertaking or a declaration telling that the moment tribunal will be constituted, appeals will be filed. Appeals will be filed. If you do both, no recovery, and this has to be done within the time limit given for filing appeals to appellate tribunal. No recovery. If you don't pay or don't give any undertaking within the time limit for filing appeals, as of now you cannot file appeals, but within the time limit recovery will start. Or you pay but you don't file appeals, when the appellate tribunal is constituted within the time. Again, then also recovery for the balance amount. Here recovery for the entire amount. Here recovery for the balance amount. Because when I tell paying the amount equal to pre-deposit. Paying the amount equal to pre-deposit. You have to pay plus given undertaking, not pay the entire amount. Pay only the amount which is equal to pre-deposit and give an undertaking that I am going to file appeals the moment appellate tribunal is formed within the time limit given. Then no recovery. But if you don't pay or don't give any undertaking, recovery of entire amount will start. Or if you pay, as of now you pay an amount which is equal to pre-deposit, but later on an appellate tribunal is formed, you don't proceed for filing the appeals, then the recovery of, not entire amount here, then the recovery of balance amount. Why balance amount? You already paid something called as pre-deposit. Here you have not paid. No undertaking. No payment, no undertaking, then recovery of entire amount. Your paid amount equal to pre-deposit now, but when appellate tribunal is formed, you don't file any appeals within the time limit given in section 112, then recovery of balance. Why I'm telling balance amount? Already you paid some amount. Balance amount will start. So this is the clarification given. So that's all about the circulars.